Hello everyone. Welcome to our 6 day CA Final Direct Taxation study sessions for the January 2026 attempt. Okay, so as you all know, you have already enrolled it in the session. So let me give you a brief idea how we shall be approaching this particular session, 6 day session. What should be your expectations to me and what I am going to deliver to you. All those things will be discussed in 5 to 7 minutes and then we shall be moving ahead with the core concept and we shall be starting with the day one, that is a PGBP chapter. Okay, understood? Now see, we shall be going to complete approximately your 70 to 80 marks of the syllabus in only 6 days. The schedule is already being shared to you that the day one you will be getting the PGP chapter, day two the capital gains and the income from other sources, day three in the assessment procedure and certain season, day four the non-resident transfer pricing and the double taxation relief in day 5 and the advanced ruling and assessment of trust in day number 6. Understood? This should be your total approach and the schedule that we will be giving to you. Now, how we should be approaching the coverage that we'll be doing is for the 100% of the concepts along with the selective important and the tricky questions. You must be getting the 316 important questions list for the January 2026 attempt. This is freely available on our website, that is www.vaibhavbansalclasses.com. If you go there in the free resource section, you will be able to find this particular PDF freely. You can download it. But if you have the enrolled student, then definitely this PDF is also available on your Google Drive. You can download it from there as well. It is freely given to you. Okay, now these are going to be the recorded sessions correctly. Okay, every day you are going to get the lectures, that the first from the PGP, capital gains, IFOS, and these types of things you will be getting, and the validity will be till your January exams with the two views. You can view a particular lecture two times, and this particular important question list, it is already available for the PDF. And if you want to buy the hard copy, you can even buy it. Otherwise, you can directly download it and print it. Okay, this is going to be our coverage. So 100% of the concept we will be covering, but in an exam oriented manner. Exam oriented manner means we are not going to discuss and go into the details and the logics of each and every section, but what we are going to do, we will be spending much time more time on the concept which is more important for the exam point of view, and we will be spending less time on the concept which is less important from the exam point of view, but we will be able to cover 100% of the concept. Every day there will be a 4 to 5 hours of the classes which will be covering your targets. Understood or not? So this is for your 6 days target. Now let me go through to the notes as well. These notes, that is a PGP notes and the other chapter notes, are also made available to your Google Drive. You can download it from here and take the printouts. Okay, this is going to be the first lecture note, that is the PGBP notes. Okay, now in the PGBP notes, see, or whatever the case laws will be there, we shall be having this particular box of the case laws. Okay, this particular box, wherever you have seen, okay, everywhere it is of used for the case laws. The amendments are shown in the green. It is of a May 25 amendment. It is not new to your attempt, but it is given as a green color. What is the interlinking that I have done for the other chapters as well? It's given in the blue color, and whatever the question point is given, it is given in the purple point. I have taken some of the examples from the question directly to explain you more in detail what that particular point want to teach us. So instead of giving my own example, I have taken a question point itself, so it would be an easy thing to recall those questions and to solve those questions very easily, because you already know what is the question point is. Understood? So what is the question point? The question asks this particular thing which is related to point number 8, so I have incorporated in that particular thing itself. Okay, done. So this is how we should be approaching each and everything. Whenever you have seen the box, it is of the case law. Understood clearly? Okay, now this should be our approach. If there is any doubt or anything, you can directly ask to me on WhatsApp. On WhatsApp, this is my number, 888. Let me write it again: 888 129 1298. It is easy to remember. 888 129 1298 is my WhatsApp number. Kindly drop a message on the WhatsApp itself. Please do not spam by calling. I am mostly in the classes, not able to attend the calls. Okay, this is my number. You can directly contact me. If there is any doubts, if there is any issues that you get while the lectures or post the lectures till your exam, if there is any doubts relating to the subject of DT, you can definitely ask to me. Okay, now shall we start with the lecture? Tell me, shall we start with the lecture? This is going to be an exam oriented session. Okay, we will be focusing on revising the things, because this particular batch, if I am here to revise you all the chapters in 4 to 5 hours a day, then I must be assuming that you have studied the DT once first. If you have not studied the DT once before these sessions, please, these sessions are not for you. You can skip these sessions. Or if you can able to cope up with these classes, then it's well and good, very very good, but it is not meant for you, I'm facing. Okay, clear? Yes. Now, starting with the profits and gains from business and profession. See, I'm not going to teach you what is the meaning of business or profession. I'm not going to teach you what is the meaning of profits. These are the basic things which we teach in the regular classes, but not in these particular sessions. Understood? And it is very logical as well. Now, coming to the chargeability section, that is section number 28. What does this chargeability section say? See, whether you know that there are five heads of income, where every kind of income is classified under these heads itself: PGBP, house property, salary, other sources, and the capital gains. Okay, correct? Yes, there are five sources of income. Now, who will decide? Who will decide what kind of income will go in the PGBP? Who will decide what kind of income will go in the head of capital gain? Who will decide what kind of income will go in the house property? There should be some section now. Who will define that these particular kind of income will go in the PGBP? These particular kind of income will go under the head capital gains. So there must be a section now. That is what the charging section of a particular chapter. Usually the starting section of that particular chapter is the chargeable section, that these kind of income that we are going to tell you will be chargeable under the head under the head PGBP in this particular case. Okay. Now, before starting the PGBP, I must tell you something very important. Okay. So whether we get these board notes and our drive, we will see. But I want you to write. So if you are writing it, well and good. If you are not writing it, I shall be uploading anyhow. Okay, but please, it is your exam. Don't play with it. Do write everything. Okay. Profits and gains from business or profession. Okay, this is the chapter that is a sorry, it's PGPP. Okay, now understand it very carefully. There are two types of thing, that is a revenue nature expenditure, and second is capital nature expenditure. There are revenue nature incomes and the capital nature incomes. Now, to understand it very carefully, okay, what does this PGBP says? See, all the revenue nature expenditures and the revenue nature's income will go under the head PGBP, will go under the head PGBP. By default, they will go under the head PGBP unless specified otherwise. What does it mean? It means that if a particular section itself says that the deduction of that particular expenditure will not be allowed under the head PGBP, then it shall not be allowed. Otherwise, in all cases, by default, it shall be allowed under the head PGBP. Okay, but for the capital gains or for the capital nature expenditures and income, by default goes under the head of capital gain. By default goes under the head of capital gains. But unless otherwise mentioned, means that if under the PGBP it is mentioned that these particular capital nature expenditure shall be allowed under the head of PGBP, then it shall be allowed under the head PGBP. Otherwise, by default it shall go under the head of capital gains. So the PGBP by default about the revenue nature of the things, whether it is expenditure, whether it is an income. Okay, until otherwise specified, it does not talk about the capital nature things. Understood? But in this revenue nature thing, if it is said that it shall not be allowed under the PGBP, then it should not be allowed to you. Is this point clear to you? First of all, keeping this particular thing very important in mind. Understood? Yes. Now coming to the notes part. Now, chargeability under the head capital under the head PGBP, that is section number 28. First point, what does it say? Read it very carefully with me. Read it very carefully with me. Income arising to any person by way of PGBP carried on by him at any time during the previous year means if a person who is carrying out what profits and gains from business or profession by him, he is particularly doing the profits and he's doing the business or profession and earning some income at any point of time during the previous year. If a person operates a business for only 2 days, whether that also constitutes a business or profession, yes, it also constitutes a business or profession, and whatever the income that he earns in those 2 days shall be taxable under the head of PGBP. The word at any time, does it clear to you? Is it clear to you? What does it mean? At any time during the previous year means it is going to be taxable whether you have done the business for 1 day, 2 day, 3 day, 4 day, 5 day, and or the whole of the year. It does not matter. If you have done any business or profession, then definitely on the income what you have earned in those 2 days shall be taxable under the head of PGBP. Now, before reading this particular thing, I want you to read this particular case law. What does this case law says? See, it's the case law of Chennai Properties and Investment Limited, and it is an important case law. You must understand it. It is an important case law. Now understand it very carefully. What does case law says that? The case law says that there is a company named Chennai Properties and Investment Limited, in whose a memorandum of association that you have already studied in the C intermediate, that there is a concept of memorandum of association. Okay. Now, there is a memorandum of association which says that the company major business, the important and the main object of the business is to acquire and let out the immovable properties. Okay, acquire and let out the immovable properties, and whatever the income that he is earning from that particular business is the substantial income of that business. Okay, the majority of the income coming to the Chennai Properties and Investment Limited is from the main objective of the company, that is to acquire and let out the immovable properties. But listen to me very carefully. They have said the immovable properties. Immovable properties. Okay. They have said immovable properties means they have not bifurcated between residential or commercial. They have not bifurcated it between that. Immovable property can be residential immovable property or the commercial immovable property. Understood or not? Tell me this. Yes. Now, understand it very carefully. The major part of the business income is coming from these letting out of the immovable property. Then, whatever the income you are earning, now, whatever the income that you are earning, that is the Chennai Properties and Investment Limited is earning, is going to be taxed under the head of PGP instead of IFOS. You cannot say the sorry IFHP. You cannot say the income is to be letting out of the property now. So it should be a house property. So it should go under the income from house property. The court rejected that idea. The court said that it is the objective of the company. Yes, the main purpose of the company is to acquire and let out the movable properties. So it should not go under the income from house property, and it should go under the head of PGBP itself, because it is your business now. So whatever the income that you are earning should go to the PGBP head only. First thing is this: Chennai Properties and Investment Limited. But this was the case law of the immovable property, not specifically mentioned whether it is a residential property or a commercial property. Understood? Now, what the people used to do? There was a immovable property. Correct? The main objective of the business is what? Letting out of the immovable property. Correct? Yes. The person, understand it very carefully. The person owns what? Residential house. The person who is the owner of the residential house owns a residential house. Now he is letting out that residential house. Now he is letting out that residential house. Residential house, important. The word important is residential house. He is letting out the residential house, and he is claiming that whatever the income we are getting from letting out of the residential house should go under the head of PGP because of the section called, so because of the case law called Chennai Properties and Investment Limited versus CIT. Is this the correct thing? Is this the correct thing? The objective of this particular case law was based on the memorandum of association, that the main objective of that company is to acquire and let out the immovable property. Although the immovable property was not clarified there whether it should be a residential or commercial. That is why there was a conflict of interest between the department and the assessee, and they used to fight with each other in every courts whether it should be applicable in the residential cases or not. Okay, in every cases the court say it should go under IFHP. In some cases they say it should go under the PGBP. Now to clarify everything, to clarify and let go all these disputes that are going on, the government said that however we are notifying to the through the finance act that the letting out of the residential house or part of the house by the owner is chargeable under the head of income from house property and should not go under the head of PGAP. But this particular thing came for the residential house property only, the letting out of the residential house property. For the commercial property, see, for the commercial property, whether the Chennai Properties and Investment Limited case law is still hold good. Yes, it still holds good. For the residential house property, they have now clarified it. It shall go under the head of income from other sources and not go under the head of PGPP. Whether this particular thing is clear to you. The first point is clear to you or not, tell me this, that whatever the income you are earning from the business or profession at any time during the previous year, the income whatever you will be earning from that business, whether the business ran for 1 day, 2 day, 3 day and 4 day, any number of days, it is going to be taxable under the head of PGBP itself. Clear? Shall I move forward? This is the first. Coming forward to the second point. See, I might be going very slow at the very start because this is the base of the chapter. When will the base is set, okay, then we shall be focusing on more important topics first, and then we will be spending very less time on the least important topics. So we will be covering in 5 and 5.5 hours. Okay, the concept shall be over, and there must be a 1 hour of the question answer session itself. Okay, for the PGP. So the chapter of PGP can be a bit lengthy, but it is important because it is a question which come in a compulsory part. You cannot skip this particular chapter. That is why you need to focus more. Rest all the chapters can come for 6 marks, 8 marks, 5 marks, 5 marks, or maybe the 10 marks. But this particular chapter minimum will come for 14 marks and maximum can go to 18, 20, 25, any number of marks. Understood? Now, point number 2. What does it say? It says any compensation in connection with the termination or modification of the terms and contract. Suppose we both entered into a contract that I shall be providing you the 6 days batch to you. Yes, valid for January 26. Correct? Yes, I shall be providing you the 2 views. And this is suppose this is what a contractual agreement between both of us. Okay, assume yourself as a business party. Right now, assume yourself as a business party. We both are in a business. Okay, we are both doing a business. Correct? Yes. Now, suppose this was written in our contract. Right now, what we have said that see, 2 views are very much. Views are very much. Students used to misuse these 2 views. How they are going to misuse these views? One view they will watch, one view they will give to their friends to watch. Okay, so by this thing, I lost my customer. I lost my customer or not? Tell me this. The other student who is a friend of my student can also buy the classes from me. Okay, can also buy the classes from me, 1,000 rupees, 1,500, any number of classes. Okay, any amount of classes, they could be my student, but because of this view facility, he does not purchase from me. He directly asks from his friend to give his one view, and he is also watching from his computer class from the student who have purchased from me. So this two views is not beneficial for me. I have seen that. So because of this, what I have said to you, suppose we are in a business relation. Okay. So we said that I want to modify this particular contract. Okay. I don't want this two views. I am doing this one. Just an example, just for an example, not doing in real, so don't worry. So I am doing this, only one view will be given to the student that he can watch it once, or maximum I can do 1.5 views, that only 1.5 times it can be watched, not the two times. Okay, understood. This is how I restricted the other student to watch from my classes. Yes, because now he had to watch my classes by purchasing it. Yes, so I had done what? I had done a contractual termination. Either I have terminated the contract or I have modified that particular contract. Correct or not? Yes. For that particular thing, do you think that there should be a penalty? There should be a penalty in any modification or the termination. You know, na, there is a penalty that you have to pay. So, whatever the penalty I am paying to modify this contract or terminate this contract to you are a business party, so the income that you receive from me in form of a penalty, in what head this particular income is going to be taxed? This income is going to be taxed under the head of PGBP, because it is in the relation of your business, because it is in the relation of your business. Understood or not? Tell me this first clearly. Yes. So coming forward, let me just revamp it. Yes. Yeah. See, any any compensation in connection with the termination or modification of the terms and contract, that is of two views of any contract relating to his business. Accordingly, any compensation, whether revenue or capital, listen to it very carefully, whether revenue or capital, you have listened it but not understood it. Read it again. Whether revenue or capital, means this time they have specifically said that the capital income is also going to be taxed in this particular case in the head of PGBP itself. Do you understand it? In the PGBP, the default setting is what? Revenue expenditure and the revenue income is going to be taxed. Okay? Or the revenue expenditure is going to be allowed only. The default setting of the PGBP is what? The revenue nature thing. But specifically, they have mentioned whether it is revenue or capital, means the capital nature of income is also going to be included and taxed under the head of PGBP for that particular income, that is termination or modification of the terms and contracts. Okay, in connection with the termination, in connection with the termination of what, or modification of the terms and contract of any contract shall be taxable under the head of PGBP. Do you understand the point number 2 as well? Understood? Now say, this is what we have done for the business. Now suppose there is a employee, there is a employer. Okay, employer said that we shall give you 60,000 per month, and it is a contract between them. Okay, it is a contract between them, but the employer had certain financial crunch or some certain things, like he is on the verge of going to the insolvency. What I am writing, I don't know. Insolvency. Okay, IBC code 2016. If he can go, then nothing will be given to them. Okay, so suppose what they are saying, that see, I can go into the insolvency, but let's work together now. Let's work together. I am not giving you 60,000 per month. Please work for me for 40,000 per month. Please work for me for 40,000 per month. So what is the contract? contract was to give 60,000 per month, but now they are modifying the contract to 40,000 per month. Okay, and for that particular thing, if there is a one-time charges paid by, if there is a one-time charges paid by the employer to the employee, that in excess of it, I am giving you 50,000 to it. Okay, in excess, I am giving you the 50,000 rupees. Okay, or this can be a condition, or this is the first case. See, this is the first case. Second case should be can be that the employer-employee relationship, earlier there was a 5-year bond. Earlier, there was a 5-year bond that the employee cannot leave the company before 5 years. If he is leaving the company before 5 years, then he must pay 1 lakh to the company. He must pay 1 lakh to the company as a compensation. Now, this particular contract is going to be modified, either modified or terminated, either modified or terminated. And for that, whatever the penalty amount or the compensation amount paid by one to the another, it is also going to be what? It is also going to be taxable. It is also going to be taxable. But under which head? PGBP. Under which head? PGBP. No, 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 no. See, there is the employee-employer relationship. And as per section number 16 of the salary, the charges section of the salary, which says that what? It says that what? It is going to where there is a salary and where there is an employer-employee relationship, the income tax under the head of salary, not PGBP. So it is going to be taxed under the head of salary. See, compensation with respect to termination and modification of the employment contract is taxable under the head of salary. Or if there is any other contract which is terminated, modification which is not in relation to the business or not also in relation with the employment contract, then it is going to be taxable under the head of IFOS. This is the interlinking that we have. Is this point clear? Point number one is clear. Point number two is clear. Tell me, are these 2 points clear to you? Clear? Coming to the point number three. This is an important point and understand it very carefully. And listen to me. Just listen to me. Okay? Yes, listening to me. Now let me do the full. Yes. Now listen to me very carefully. Suppose there is a bar council, not the bar wherever you go, okay, at every night. That is not the bar. Okay, the bar council, which is an association of the lawyers and the judges. Okay, now there was a suit on me. Okay, I want the best lawyer to fight in defense of my case. Okay, so I wanted Mr. Harish Salve to fight my case. But whenever I go to the office of Mr. Harish Salve, the PA of the Harish Salve dismissed me from the office and said that he's busy, he is not going to meet you right now. Okay, I tried various times, but he's not letting me to meet Mr. Harish Salve because he's a very busy and busy person. But I am also the lawyer. I am also the member of the bar council. I tried something new. I went to the bar council and said that Mr. Bar Council, do one thing. I am having a case on me. I want the best lawyer to fight my case. That is Mr. Harish Salve. Okay, he is not letting me meet directly. So I go through the bar council, and the bar council writes to him that you can consider of fighting the case of Mr. Vaibhav Bansal. So in that particular case, he might consider that request. He might consider that request. So I requested specifically to the bar council, to the association to fight my case. See, this is the services which is not performed generally for everyone. Okay, it is not the services that is performed generally for everyone. So what is done in that particular case? The member, because I am the member, that is why the bar council provided the specific services to me, not the general services, not provided to all the members of the association, but only provided to me. That is a specific services performed for a member. And suppose Mr. Harisalve agreed as well, he fought my case and I when everything was done correctly. But what is this particular thing? Understand it? What does that particular thing? The trade association, similar associations or the profession performed any specific services for its member, that is Mr. Weber Bansal. So whatever the income that whatever the money I am paying to the association for doing that particular job, that they approach Mr. Harish Salve and request for my case, for that particular thing, whatever the money I am giving to them, it is going to be taxable under the head of PGBP for them. Is it clear or not? Tell me, is it clear or not? Tell me this. Okay, clear. Now, point number three, which is also clear to you. Now, understand it very carefully. Income derived by trade, professional, or similar association from specific services performed for its members. Okay, so the point number three was clear to you or not? Tell me this. It is clear to you or not? Done. Now, coming to the point number four, that is the profits on sale of import entitlement license. Import entitlement license. Understand it very carefully. Okay, understand it very carefully. Suppose, let me close it. Yes, import entitlement license. Suppose India is now moving ahead with the Made in India concept. Correct? Made in India concept. India is moving ahead with this because of Mr. Donald Trump. Yes, he does not know what he is going to say tomorrow. He does not have any idea of anything. Yes. So, in the era of uncertainties of Mr. Donald Trump, Mr. Donald J. Trump, give them the respect, give him the respect. Okay. So, India is moving ahead with a Made in India concept. Okay. So, promote Made in India concept, the government of India said that whatever the defense item, suppose whatever the defense items we are importing the defense items, we must stop it or restrict it. We must restrict it. Okay, let us take an example of not stopping, just to restrict it. Okay, government want to restrict it, so the government put a cap. That maximum of 100 crore rupees, of these defense item can be imported throughout the year. In aggregate, only 100 crore rupees of the defense items can be imported. This is the restriction, this is the cap that is maintained by the government of India. Understood or not? Tell me this. Tell me this whether you have understood this or not. Yes? Now understand it very carefully. Now, what happened? The government called all the importers of these defense items, and suppose there are 10, there are five defense, there are five defense manufacturers, okay, who import these particular defense equipments. The government said that, okay, 25, 20 crore to you, 20 to you, 20 to you, 20 to you, and 20 to you. We have given you the 20 crore rupees of what? Import entitlement license to you. Now, what does it mean? You can import for 20 crore, 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 and you also can import for 20 crore. In aggregate, government target was completed or not? Government put the restriction that you cannot import for more than 100 crores a year, and it has given a import license to everyone that you cannot import for more than 20 crore rupees a year. Understood or not? Yes. But there is a twist. There is a twist. Understand it very carefully. What is the twist? This particular company, that is a company number one, has only the orders of 18 crore rupees. Have only the orders which can be fulfilled in 18 crore rupees of the import. Okay. But suppose the company of the second company wanted to import 22 crore rupees of items because he have more orders. Understand it or not? He have more orders. That is why he want 20 crore, 22 crore rupees of import, but company one only needs 18 crore of import. So what they can do? They can swap. They can swap. Means what? Means what? Understand it very carefully. Means what? He have what? 2 crore rupees in excess, which will not be used, which will not be used by company A, company one. Okay, he have 2 crore rupees in excess, but company two has 2 crore in deficit to import, because the government put a cap na that you cannot import for more than 20 crore rupees, but he wanted to import for 22 crore rupees. He wanted to import for 22 crore rupees. So what they have done, the ex license of 2 crore rupees which is in balance of Mr. of the company one, they sold that particular license of 2 crore rupees to company second. To company second. See, I have 2 crore rupees extra, but you have 2 crore rupees less. So take the 2 crore rupees of license. Okay, you can import it because I have it extra. That for that definitely company two will pay something to company one. Correct or not? This is what the profit on sale of import entitlement license. Is this point clear to you? Import entitlement license means whatever the license which is entitling me to import something. Okay, understood it. So if they are doing like this, they are going to earn some profits, and their profit is going to be taxable under the head of PGBP. See, these are fulfilling the same. These are importing only 20 crore rupees. See, in all, finally, 100 crore rupees of import is done now. Finally, 100 crore rupees of import is done now. So the government is not going to do something, not going to do anything, because whatever they have done, they are just swapping with each other, because my target is not going up. Okay, my limit, my cap is not breaching. That is why the government is not interfering in this particular thing as well. Bolo, is this point clear to you? So this is what profit on sale of import entitlement license. If you get any of the profits, then it is also going to be taxable in your hands. Now, okay, same thing. The exports. See, government wants to increase the exports. Correct or not? Government wants to increase the exports. Yes, like the defense equipment. Do you know that the government has a policy that they want to increase the defense exports of India? Yes, they are making the BrahMos missile. Understood? Okay, we have, I mistakenly, they say, I am not saying anything. The government said that by mistakenly we have launched it in the on the Pakistan. By mistake. It is not our fault. Okay, by mistake it went to the Pakistan. Government is saying that. I am not saying anything. Okay. So Government want that it was just our mistake, na. We want this kind of mistake to be done by every nation. We want this kind of mistake should be done by every nation on Pakistan. Like Afghanistan should also drop. Indonesia shall also drop. Philippines should also drop. Iran should also drop. Okay, Israel should also drop. Every nation should drop BrahMos missiles on Pakistan by mistake. By mistake. So I want the export to be boost up for the BrahMos missiles. Yes, the government is also talking in the Indonesia and the Philippines nation not to sell out the sell out the BrahMos missiles. Yes, yes. So in that particular thing, understand it very carefully. Government want to increase the exports. Government want to increase the exports of something. So for that particular thing, if they are giving some support, if they are giving some support in form of cash to boost the exports of a company, to boost the exports of a company of that particular product. So whatever the receipt you are getting in form of cash compensatory support, it is also going to be taxable under the head of PGBP. Clear to you or not? Yes. Point number six. Duty repaid or repayable as drawback under the head of under the customs. You all know that under the customs you need to pay the duty. Okay, the IDT sir and ma'am will teach you all these things under the Customs Act. Okay, you need to pay some duty. Whether you are exporting, you need to pay some duty. Whether you are importing, you need to pay some duty. Otherwise, they will not dispatch your products from the goods from the warehouse. Understand? You have to pay some duties. Yes, but suppose that government want to do what? Government want to increase the exports. Government want to increase the exports. So for that particular thing, what the government said that see, the restriction is given on the customs now that they have to collect the duty, pay them the duty. We will refund that duty to you. We will refund that duty to you. That duty is repaid or repayable as drawback. Okay, that is also going to be taxable under the head of PGBP. And the same, there are two more words that you need to remember, that is duty entitlement passbook scheme or duty free replenishment certificate. If there is a profit on transfer of these two things, then also it is going to be taxable under the head of PGBP. Then also it is going to be taxable under the head of PGBP. Are you understood? Have you understood these particular things? Tell me this first. Clear? Shall I move forward? Yes. So now coming to the point number eight. What does this point number eight says that? Understand it very carefully. If the manufacturer, suppose there is a manufacturer who gives some gifts, benefits, or purposes to its sales team, to its sales team to fulfill that particular criteria or particular targets. Suppose the manufacturer gives the sales team a target of sale of approximately 80 lakh rupees a month. Okay, if this particular target is met, the commission of 30,000 rupees shall be given to the sales team. Okay, so the manufacturer give benefit of purpose because of the business or profession, to the business of profession only, whether it is convertible in money or not, whether it is in cash or in kind, or might be in partly in cash or partly in kind. In any of the thing, if for the business of profession, anyone gives the benefit requisites and give to the some person, whether it should be in cash, it should be in kind, partly in cash, partly in kind, anything will work. Okay, if it is given for the business and purpose, then any gift, whatever it is given to them, it should be taxable under the head of PGBP. So the gold jewelry valued at 30,000 rupees received as gift from the manufacturer for achieving the sales target. It should go under the head of PGBP and shall be taxed under the head of PGBP. Understood this or not? Tell me whether it is understood this or not. Now, coming to the point number nine. What this point number nine says that? See, any interest, commission, salary, bonus received by a partner from a partnership firm. Who is giving the interest, salary, bonus, commission? Partnership firm is giving. To whom it is given? Partner. But sir, see, interest is there, salary is there, commission is there, bonus is there, but the part of profits is not given there because the part of profit which the Net draws from the partnership firm is going to be exempt under the head of under the section 10 to A. Do you understand this point number two? Partner share in the total income of the firm will be exempt in the head of under section 10 to A. That is why it is not talked about in the point number 9, because it is usually going to be what? Exempt. Yeah. Now, do you understand that for the interest and salary, there is a limit? For remuneration, there is a limit. For interest, there is a limit. How much the interest can be given by a partnership firm to the partner, the limit is set. How much the remuneration given by the partnership firm to the partner, the limit is set. Yes. What is that limit described under which section? It is described under section number 40B. So up to the extent of 40B, it is allowed. Otherwise, it is going to be disallowed. Understood or not? And see, suppose if there's any interest, salary, commission, bonus, if it is given in excess of 20,000 rupees, then there is a TDS liability to be paid by the partnership firm, correct or not? They need to deduct the TDS liability. They need to deduct the TDS at the rate of 10%. Yes. So above 20,000, if they are paying, so the partnership firm will deduct the 10% TDS under section number 194T. All these three things, do you understand? See, this is the level of interlinking we are going to do in these particular chapters. Understood that you should have a whole 360 degree of view in respect of that particular points. Clear to you? Understands? Okay, very good. Now, point number 10. It is going to be an important point. Point number, any sum, whether received or receivable, either it is received to you or it is going to be receivable to you as it is accrued, whether in cash or in kind, under an agreement. What? Under an agreement. The word important is what? Under an agreement. Okay. No, not caring. First point and second point. First point is what? Non-compete fees. Non-compete fees. And second is one what? Non-sharing fees. Understand it very carefully first it. Just a second. Let me just do it. Yes. Come here. Non-compete fees. What does it talks about? Understand it very carefully. There is a institute that is a Vaibhav Bansal classes, correct? Yes. There is also an institute ABC classes, correct? Now, Vaibhav Bansal classes provides the CA final direct text classes, okay? Provided in Hindi, provided in English. Correct? You are watching the classes in English as well. Okay, yes. What is the verticals they provide? They provide CA final direct taxation. Also, now the promotion alert comes to you. They also provide the Sampoorna book. They also provide what? The Sampoorna book, which is the ultimate guide for SCPM, either in Set B exam or in IBS exam. It comprises of just 150 pages plus of concepts, 150 plus pages of concept, only 150 around, okay, where the infographics, charts, diagrams, everything is covered and completed the whole ICAI material of 800 plus pages. Okay, we have comprised in 150 pages without leaving a single thing. We had comprised each and everything. It is also available for sale www.weberbansalclasses.com. You can take it because in the IBS, ICA is targeting the SPUM subjects. Like in the September 25 examination, they have asked from the in the IBS exam, they have asked the SCPM of approximately 20 marks. They are targeting on the set A, set B because the students might have studied the group 1 way earlier, so they are not asking very much amount of questions on the group 1 because we want the students who are giving only group 2, so the group 2 subjects plus the SPM subjects can be just make them free. Just by solving the group 2 subjects and by solving the SPM subject, he can be passed and with a good marks. So approximately of 60 to 70 marks of the paper will be asked from that particular thing only. So the students who take the tension of group 1, this is the solution. Okay, you cannot leave the SPM subjects. That is why we have made a Sampoon book that is available for sale. You can take it. The promotion is over now. Now coming to the concept. Okay. Now see, Vaibhav Bansal classes provides you the direct taxation, CFI and direct taxation classes in the Hindi and English. Okay. Now there is a ABC classes. They also provide the CFI and direct taxation. Also in Hindi, also in English, also in Hindi, also in English. Now VVC, that is Vaibhav Bansal classes, did what? We entered into an agreement with ABC classes. It said that, see, I will operate in English, you operate in Hindi. I will not enter into Hindi, you will not enter into English. Because if we enter into both the businesses, we will end up with competing each other and the students will be lost and everything. There will be a loss of students. We discussed everything. But at the end, we reached to a conclusion that okay, I shall be teaching only English and he shall be teaching only Hindi. So there is an agreement of non-compete. We will not compete with each other. So whatever the agreement is this na, whatever the exchange of the compensation will be there na, that particular concept compensation, whoever will be receiving that shall be taxable under the head of PGBP, shall be taxable under the head of PGBP. See, in this particular example, we have given a fair deal that both will lose something. But suppose there can be a situation where VVC is bigger entity. He said, I shall be operating in both the things. Okay, just keep rupees 50 crore rupees. Take 50 crore rupees and leave the English market and leave the English market. Only I will be teaching in English. You cannot teach in English. You can teach in Hindi, but do not teach in English. Take 50 crore rupees from me. So apparently I am giving him the 50 crore rupees now. So this 50 crore rupees which I am giving to him shall be taxable under the head of PGBP. Understood this one thing? Yes. The person who is receiving this, the person who is receiving this will be taxable under the head of PGBP. But there is a right. Suppose, see, there is a right that we acquire that we shall be operating in Pan India for the English classes. No one other will come in the English classes. This is my monopoly. This is my right that I acquired for 50 crore rupees. Understood or not? So this is a right to me. This is a right to me. And right is what? An intangible asset. Right is what? An intangible asset. And for the intangible asset, there is a depreciation. There's a depreciation at the rate of 25%. So I shall be claiming 25% of the depreciation and he shall be paying tax at the rate on this particular income. But wait, I have paid 50 crore rupees now. So in my PNL, I must have debited 50 crore rupees. Correct or not? In my PNL, I have debited 50 crore rupees as expenses for acquisition of right. But when solving of the PGP question, you will say that no, it shall not be allowed to you. It is not a upfront payment. So you will add it up in the PNL and give a depreciation deduction at the rate of 25% in it. This is your major part of the adjustment that major of the students feel difficult. Okay, understood? This is a right for VVC. So for that, it is not a it is not a PNL item. It is an asset, na. It is an asset. It creates the asset, na. So it is not an expenditure. Okay, it is not a expenditure because it creates an asset. So for that particular purpose, you can take the depreciation. You can debit this particular amount of depreciation in PNL, but you can't debit the whole 50 crore rupees in the PNL. Understood or not? That is why the adjustment came that this 50 crore rupees which is already debited in the PNL need to be added back and you can take the deduction of depreciation at the rate of 25%. Tell me this, whether is this clear to you? Whether it is clear to you? Done? So, see in the notes. For carrying See, under agreement, there must be an agreement first. For not carrying out any activity in relation to any business or profession, that is a non-compete fees. For recipient, it is going to be taxable under the head PGP. For the payer, non-compete fees is an intangible asset, shall be depreciated at the rate of 25%. But they have said that this clause shall not be chargeable to PGBP under the following circumstances. Means the non-compete fees, whatever we are receiving, will not be taxable in the head of PGBP in these two cases. What are these cases? Where any sum received is going to be taxable under the head of capital gains, then it is going to be taxed under the head of capital gains, not going to be taxed under the head of PGBP if it is explicitly given. And for the case of carbon credits as well, they are not going to be taxed under the head of PGBP. Now for the compensation received from the case of carbon credits are going to be taxed under the head of under the section number 115 BBG. Now what is the carbon credits? It is same like what? Import entitlement license. So what is the difference between the both import entitlement license and the carbon credits? See, understand it very carefully. Let me do the full screen. Yes, my voice is now audible. In the earlier part of the lecture there was a voice missing, so I have to speak it again. Okay, so listen to me very carefully now. There is a body called COP26. Do you know that? Climate and pollution related authority across a world level. Okay, like a United Nations, there is also a climate related authority, that is a COP26, which talks about the climate protection and all. Okay, so do you know that there are carbon emitting companies and the industries across world? Okay, so the countries met on COP26 and decided to reduce the carbon emission to protect ozone layer and to protect the earth from the pollution. Okay, understand? So the countries decided that we shall be giving a carbon credit to each company who shall be emitting the carbon. What are they saying? That they are saying that we shall not allow a company to emit carbon in the nature in excess of the capacity that we provide. If we provide, suppose, if we provide a company that you can only emit a carbon emission can only be done by you of approximately, suppose, this much of units. Okay, suppose 100 units of the carbon emission can be done. Okay, they can be measured in any units, I don't know, whatever the unit is. So the 100 units can be emitted by you in the industry, in the nature. Okay, environment. Understood? One company given 100 units. Second company was given 50 units only because the operations were low for that particular company. Now the same thing came. They utilized 98 only, but they want 52. So they are giving each other the swap. They are giving the carbon, which is credit. The carbon credits are given to each other because they need 52, but they only use 98, so they have two excess and they have two deficit, so they are just transferring to each other. So what is the compensation received for the carbon credits? Okay, on the transfer of carbon credits, understood, shall be taxable, shall not be taxable under the head of PGBP. Understood or not? Yes. Now same the non-sharing fees. Now what is the non-sharing fees? Suppose, again listen to me, don't see in the notes, listen to me very carefully first. What is the clause? Suppose, see, the clause is what? Non-sharing. Just listen to me. I and you are talking only. No one shall listen to it. So listen to me very carefully. Okay. Not sharing profits, not sharing compensation is what? See, I have made a formula. Correct. Let me take an example. Practical example very much. Do you know the company called Mama Earth? Yes, providing the facial beauty and all. Okay, yes. The owner of the Mama Earth on a recent podcast said that we have made a formula of a shampoo through the chat GPT. Array, understand it very carefully. They have made a formula of a shampoo from a chat GPT. They give the command to the chat GPT to make a formula of a shampoo and they give some description of it. What does that particular shampoo do? Okay, yes, the chat GPT gave a formula to them and she, the owner of the Mama Earth, gave that formula to the Scientific team and the scientific team tested the formula, okay, and there is a liquid came, okay, as a result the liquid came. Yes, after the changes they approve it or they sell it, everything they can do. But what is the thing is, the chat gpt made a formula for that, the power of AI. But listen to me very carefully. If instead of this AI, if the formula was made up by a scientist, understand it very carefully. Now, the scientists know the main product of the Mamaearth or not. Yes, the shampoo or other facial things or not. The scientists know the main formula of that particular product, which is the most sold product of Mamaearth company. If the scientist is compromised to any other rivalry company, then the Mamaearth will collapse right now. Yes or not? Yes or not? Tell me this. Yes, correct. So for that particular thing, na, there is a contract, there is an agreement signed between the scientist and the company. That is a non-disclosure agreement. Or a, do you understand that? Non-disclosure agreement, that you cannot disclose or no, you cannot share the secrets, the trade secrets or the formulas of our company to any other company that is a rivalry company. Understood or not? So for that particular thing, if something is given in return, Array, I am signing that. I will not share. I need something. I need something as compensation. If I receive something as compensation, that is what a non-sharing fees. It will not be. It is given for that. You should not share our trade secret, our formulas, our know-how, patent technologies. You should not share with any other companies. For not sharing something, we are giving you what? A compensation. So that particular compensation is also going to be taxed under the head of PGBP. Understood or not? You need not to share this. This is a not sharing fees. That is why it should be between us only. Understand it very carefully. So not sharing any know-how, patent, copyright, trademark license to any other thing. So if it is relation to our business, then it is going to be taxable under the head of PGBP. Now, point number 10 is also clear to you. Easy. Yes. Now coming to the point number 11. Now coming to the point number 11. What does it say? See, after becoming CA, you open your own company. Okay. After becoming CA, you are not an orthodox type of a person who will do a practice or like us, like we are in teaching. Okay. You don't want to go there. You want to run your own business. Okay. You started your startup. Okay. And in that particular startup, there are key men. Key man means the most important person of your business, like a CEO, CFO, COO, CCO, these kind of thing on whom C is written. Oh, not that one. Just chief. Chief wala C is written, not that wala C. Okay. The chief wala C is written. So mostly these are what the key men of that particular company. So we want to retain them. We want to retain them because they are the most crucial person of our business. So to retain them, what the company do? They made a insurance policy on their name. They made an insurance policy on their name. So on maturity, that insurance policy, whenever it gets matured, it matured with a bonus. Something bonus component is also there in that particular policy. So after maturing that policy, the key man insurance policy including the bonus. Okay, if it is received by the company on the maturity, then it is going to be taxable under the head PGP. If it is received by the employee on the retirement, then taxable under the head salary. And if it is received by any other member who is not in employer-employee relationship, means like an independent director. Independent director, if he is in the employer-employee relationship, then he is not independent. That is why there is no employer-employee relationship between the independent director and the company. So in case of an independent director, it is going to be taxable under the head of IFOS. Now, whether a partnership firm can do an insurance policy for their partners? Yes, it is also allowed. The KIP is what? Key man insurance policy for the partner is also allowed. And whatever the premium is paid by the company for that particular purpose will be allowed as deduction under section number 37. That is a general deduction section. Understood or not? Point number 11 is also clear. Shall I move forward? Shall I move to point number 12? Correct. So in point number 12, what is happening? Understand it very carefully. These point number 12 and point number 13 will also come in the capital gains. Will also come in the capital gains. Now understand it very carefully to me. Now understand it very carefully to me. Fair market value of inventory on the date of conversion on treatment of a capital asset. What does it mean? Whenever a capital asset is converted into a stock in trade and then stock in trade is sold, then you do a two type of calculation. One is for capital gains and second one is for PGBP. Do you know that? I am assuming you have done the whole DT once, so I can expect this. Okay, so you calculate the PGBP part now. Yes, I calculate the PGBP part because of this particular thing, because it says that the fair market value shall be taxable under the head of PGBP. And when you will calculate the capital gain, it also comes because of that, because it also covered under the definition of transfer 2 clause 40. Clear or not? Understood. Now the same thing is that point number 13, which says that if there is a capital asset, if there is a capital asset on whose section number 35 AD deduction has already been taken, okay, and which is being demolished, destroyed, discarded, or transferred, and whatever the sum that we have received on that particular transaction, whether it is in cash or in kind, will be taxable under the head of capital gain. So whenever you will see and whenever you will solve the questions of section number 9b and 45.4, that is tax on reconstitution and dissolution of a partnership firm, then also you are going to calculate the PGBP income. Why you are calculating the PGBP income? Because it is written in point number 13 that it is going to be taxable under the head of PGBP. The chargeable section itself clarifies that it should be taxable under the head of PGBP. That is why you compute the PGBP in point number 12 and point number 13, that is in the capital gains. Tell me this first. Do you understood? Do you understood these things? Yes, sir. We understood. We understood. So this completes your section number 28. Do you understand it? How are you getting these lectures? Are these lectures have helpful for you? Please do write in the number on the number that is provided to you, 888 Okay, we shall be more than happy to listen the feedbacks from you. It is a motivation tool for us. Okay, now so please give us the honest feedback. Okay, but the positive feedbacks. Negatives are also allowed. Okay, you can give the negative feedbacks as well. What need to be improved, we can only know by your feedbacks itself. Now coming to the speculative business income. Now, do you know that the speculative business, so speculation business are there, are deemed as separate and distinct business, not treated as same business of a normal business, and the losses of a speculative business only be set up from the speculative business income. But understand it very carefully now. Now understand it very carefully. There is a confusion between the students on one point. Understand it very carefully. Loss of speculative business. Loss of speculative business can be set off with the profits of speculative business only. Understood? Yes. But suppose we have a loss on normal business. We have a loss on normal business, but we have a profit on speculative business. Whether they can set off or not. Whether they can set off or not. Yes, they can set off because the restriction is given on the loss of a specified business. But the loss can only be set off from the profits of a speculative business only. But the loss of normal business, to set off the loss of normal business, there is no kind of restriction. The restriction of section number 73, that is put on the loss of a speculative business itself, not on the loss of normal business. So the loss of normal business can be set off with the profits of a speculative business as well. Understood, sir? But you have said that what this is to be treated as separate, distinct, and the loss can be set off from this or not. But what speculative business? They say speculative business is like nothing. There is a transaction. of purchase or sale of any commodity, okay, on periodic or untimely basis. But the main point is that the settlement is not done on a actual delivery basis. The settlement otherwise than by a actual delivery means the settlement is done by a price difference. The settlement is done by a what? Price difference. Go to your AFM faculty and ask them, please teach us derivatives. Please teach us derivatives. You will go to understand there are two kind of methods of settlement, that is actual delivery or the price difference. In the derivative chapter also you do the price difference settlement only. You normally do not do the actual delivery. Understood? Now, they said that there are certain kind of companies who will do these kind of businesses. Okay, but we will not assume that they are doing the speculative business. Means that these are the two companies. We should be assuming they are not doing the speculative business. Either they are doing the same thing, or they are covering under the speculative transaction, but we will not assume that they are doing the speculative business. What are those companies? Okay, they say that first company is what, whose gross total income consists mainly of interest on securities, income from house property, capital gain, or IFOS. They are not earning anything from the PGBP income, so they are not in the speculative business. Second thing is what, the companies whose principal business is in trading shares of banking, granting loans and advances, whose major business is what, a speculative nature of transaction. There it is normal kind of business. We will not treat it separate and distinct from normal business because they have their normal business as a speculative business. So both is the same thing. So for them, the normal business is equal to the speculative business. That is why we will shall not deem it as a speculative business. We shall be deeming it as a normal business. See, whatever the sections are not relevant as much, I am taking it in fast manner. Okay, now following transaction not deemed to be speculative transaction. First of all, we have said that the following company shall not be deemed as a speculative business, that they are doing the speculative business. Now what we are saying that the following transactions we will not assume it as speculative transaction. Now it is very easy to remember all those transactions. See, what you need to do? Yeah, just you need to do, just recall every concept of derivatives in the AFM: hedging contract, forward contract, derivatives contract under the recognized stock exchange, trading in the commodity derivatives on which CTT is paid, but the CTT is not applicable on the agriculture commodity derivatives. That's it. For the agriculture commodity derivatives, CTT is not applicable. Understood? Now coming to a case law. This case law is also important, that is a CIT versus KNT company. CIT versus KNT company. Now listen to me very carefully. There is no need to watch the notes. Watch me. You need to see me. Okay? I'm looking handsome either. Just listen to me very carefully. What I'm saying to you. There is a company, K and company. Yes, they want to sell some lottery tickets in the state of Assam. So the Assam government want to issue a license to sell the lottery tickets. The license from the state government had to be taken. Yes. But the state government does not give the license directly. They need a bank guarantee on that particular behalf of the company. Okay. If the company will not pay the amount, the bank guarantee, the bank will pay the amount. Okay. So for that particular purpose, the company need to take a bank guarantee from the bank, and then the bank guarantee to be submitted to the state government, and afterwards only the state government will give them the license to sell the lottery tickets. Understood? This is very much clear. Now, what happened is K and company went to the bank. Sir, please give us the bank guarantee. I have to give to the government of Assam because I want to sell the lottery tickets. The bank said, okay, very good. What will I do? How will I give you the bank guarantee? To give the bank guarantee, I must have a guarantee, na? I must have something in return, na? So the company, the KN company, gives some deposit margin money. They have to deposit some margin money. What is the margin money? They will decide to buy the bank. Okay. So they have to first deposit some margin money with the bank. Okay. They have deposited it. Bank has deposited it. Okay. Now on that behalf, on that margin money behalf, the bank give the bank guarantee to the KN company. KN company gives the bank guarantee to the bank, to the government of Assam, and the government of Assam gives them the license to trade in the lottery tickets or to sell the lottery tickets. Understood or not? Now, whatever the amount lying in the bank account of the KN company, that was the margin money. That was the margin money. At the end of the whole transaction, he ends up earning some of the interest on that margin money because it was deposited in the bank. So the interest accrued and he earns some interest income. And you all know the interest income is chargeable to tax under the head of IFOS, income from other sources. So this is the only. The KN company said that no, it is going to be taxed under the head of PGBP because it is in relation to the business. The assessing officer said that no, it is an interest income, and as per the section number 57 of the IFOS, 57, 56, 57, 56, check out. Okay, IFOS charging section says that what? It is going to be taxable under the head of IFOS because it is a interest income. This is the fine. Now, in that particular fight, the court came and the court said that it is important for the business. If that bank guarantee does not, if the KN company does not get that the bank guarantee, he could not operate in his business. He cannot do his business. So for to obtain the bank guarantee, he must take out what? He must take out the bank. He must to submit the margin money with the bank. Yes. So instead of saying the word important, if they say the word important, then everyone can understand. Na, you and me can become a lawyer. You can me become a lawyer. You and me can become a judge. But they have to maintain their monopoly or not. They have to maintain their monopoly. Anyway, they have not used the word important. They have used the word inextricably linked to the business. Oh, ho, ho, ho. What I have said, listen to me very carefully. They have said that inextricably. Feel the word inextricably. We'll again also with me, just with me with the field. Inextricably linked to the business. Inextricably linked to the business. If they want to say important to the business, but they are not saying important. They are saying inextricably linked to the business means without this the business cannot operate. Without this the business cannot operate. They just want to say the thing. Understood or not? Tell me this first. Clearly, this is what they have said. No, listen to it very carefully. What the court said that it was inextricably linked to the business. That is why it is in relation to the business of the SSC. Without this, the business cannot operate. So this is the income, the interest income which is earned on the bank on the deposit of the margin money with the bank is going to be taxable under the head of PGBP and not under the head of IFOS. Understood? Clear? Okay, listen to me. See, listen, just read this particular CIT versus Kent company. Just read it first, jaldi fast. Understood, understood what they said. They see, Asati had to deposit margin money with bank for obtaining the bank guarantee, and such guarantee is essential for the assessee's business. Any interest earned on such deposit will be taxed in the head of PGVP as the interest is what? Inextricably linked to the business. Do you understand the feel of these words? Do you understand the feel of these words? I mean, do you understand the feel of these words? Clear? Understood? Now coming to the heart of heart of the PGBP. I am saying the heart of the PGBP. Usually the teachers will not see this particular chapter and this particular section as the heart of PGBP. They used to say it is irrelevant section. They used to say there is nothing in this section because this section gives you the pathway. Okay, this section does not say in specific to what is going to be taxable or what is not going to be taxable. This section does not say anything. So most of the teachers used to do what? This section. Okay, this is not an important section. The rest of the section is important, but I say this particular section is the heart of the PGP. See, while reading this particular section, na, you can feel the philosophy. You can feel the philosophy, the nature of this particular section, that nothing is mine. Nothing is mine. See this philosophy. When we went to the 29th section, then please give us the method how we shall compute a PGBP income. Please give us the method how we shall compute the PGBP income. Instead of giving the method, instead of describing the whole method, they said nothing is relating to me. Nothing is relating to me. Everything is related to the other section. What does it mean? It says that don't ask me. You go to the section number 30 to 43D. 30 to 43D. Whatever they are saying now, whatever they are saying, just do that. Again, listen to me very carefully. Section number 20. Feel that philosophy, feel that intentions, feel that purity in section number 29. It says that nothing is mine. Go to section number 30 to 43D. Whatever they say now, whatever they say, just do that. And after doing that, whatever the amount comes now, this is what PGVP income is. This is what PGVP income is. This is what me. Section number 29 is what? Computation of PGVP income now. So that's it. What is the PGVP income? We are asking from section number 29, what is the PGVP income? It said that I am nothing. Go to section number 30 to 43T. Whatever they say, just apply it. And after application of all those sections, whatever the amount comes, this is me. See the beauty. See the philosophical nature of section number 29. Now the section number 29 is over. Okay, what they are saying that income referred to under section number 30 28 shall be computed as per the provisions of section number 30 to 43T. Now, section number 30 to 37 talks about what? Admissible deductions. Means some of the deductions shall be allowed as deductions. Okay, some of the expenditure shall be allowed as deductions. Is given under section number 30 to 37, which is an important section. Section number 40 says that, oh, well, do not take deduction from me. Do not come to me to take deductions. I will not going to give you the deductions. So section number 40 talks about that. I am not going to give you the deduction. Section number 40 said that I am also not going to give you the deduction, but in certain cases. But in certain cases. Okay. I shall be giving it, but I shall not be giving it in certain cases. Okay. So next thing. Next thing here. Section number 41, which says that profit chargeable to tax. Section number 41 is very rare section, very selfish section. What does it say is that understand the feel of these things, you will understand the chapter very easily. Section number 41, the feel of section number 47, 41 is what? Selfishness. He sees some income, he sees some profit, he want to charge that profit to tax. He want to take out some profits, he want to take out the tax from that particular profit, but he is not getting something. On which income, from which section, which head we are going to tax this income? I'm not getting anything. What section I am going to tax something? In any of the section of PGBP, this income is not getting taxed, but I want to take tax on this particular income. I am being very selfish, I want tax. So this section number 41, will assume in its own that this particular income is going to be profits and it is going to be taxed in the head of capital, in the head of PGBP. And this is what a section of deemed income. We will assume this. It is not an income. I know and you know. We both know this is not an income. But we will assume this. This is an income and you need to give tax on this income. So see the selfishness of this nature. The selfishness of this section, that is section number 41, that profits chargeable to tax, we will assume this. It is going to be a deemed income. And last, other provisions, the miscellaneous provisions, which is what? Presumptive taxations and other rest of the things. Okay, some deductions of the chapter number, some deduction which are used to be important for calculating the PGBP income. So this is whole PGBP. This is the whole PGBP income, which comprises, well, means section number 29 comprises the whole PGBP. How important section number 29 is. Whatever it is written like a one line, okay, but feel the heart of this section. It comprises, it holds all the section of PGBP. So this is the mother section. Okay, this is the heart of the PGBP. So feel that way, feel with that purity, Yes, section number 29 is very important. Understood. Shall I move forward? Okay. Have you felt that? Very good. Okay. Moving ahead with admissible deduction. Moving ahead with admissible deductions means certain kind of there are certain kind of expenditure we shall be deeming it as, we shall be allowing it as deduction, that we shall be giving the deduction of these incomes. Understood or not? Of these expenditure. To section number 32, section number 37. From section number 32, section number 37, we shall be dealing it with. Okay. Now coming to section number 30 and also read with section number 31. 30 and 31 need to be taken in togetherness. Okay. Section number 30 talks about building. Section number 30 talks about building, whereas section number 31 talks about machinery, plant and furniture. Talks about what? Machinery, plant and furniture. Okay, first thing is this. First, second, section number 30 talks about rent, rates, taxes, repairs and insurance. But section number 31 talks about only repairs and insurance, not talks about the rent rates and taxes, not talks about the rent rates and taxes. Understood or not? Understood or not? Yes, it is very clear to you. Now, this is the basic difference. Now, this is saying that whether the building is owned by a tenant or owned by a owner, there can be two possibilities. Yes, rent will be paid by whom? Only tenant. That is why it shall be allowed to the tenant. The owner will not pay the rent now, so it is not allowed there. Okay, amount paid on revenue repairs, revenue repairs, so it is going to be allowed, it is going to be allowed to both, because I have said na, in the PGBP there is a default setting that the revenue expenditure is allowed until otherwise stated. Correct? Yes. Now, for the capital repairs, for the capital repairs, it is not going to be allowed. Now, this is something which is wrong. You need to do in above. Okay. It is a part, the blue part is also a part of what? Capital receipt. Okay. It is also a part of capital receipt. So, you need to do in the above portion. Okay. Understand very carefully, or you can remove this particular line. Okay. I will try, I shall be uploading the notes after solving this particular thing, that what to be added or what not to be added. Okay. Now, so listen to me very carefully. Amount paid on account of what? Capital receipt. On account of what? Capital receipt. So it is not going to be allowed. But they have said that if there is a capital receipt now, so for the owner, we shall be assuming it is a cost of the building, and we shall be capitalizing it, and on that basis the owner can take a depreciation on that particular asset. Okay, so owner is sorted. But for the tenant, the company, the section itself, this section number 37, we shall deem it as at we shall deem it as a building, like it is his building, because as per section number 32, explanation to section number 32 said that the depreciation shall be allowed to a beneficial owner. The depreciation shall be allowed to a beneficial owner. In that particular case, who is the beneficial owner? The tenant is the beneficial owner. That is why it is written that if it is a beneficial owner, so we shall be deeming it as a building, and on that basis the tenant can also take what? Deduction of depreciation. Municipal taxes is allowed to both. Is allowed to both. Either here as well and here as well, allowed to both. And for the insurance premium paid, it is also allowed to both. Now, if any cess, rates, taxes which is paid by the foreign governments are also allowed, levied by the foreign government, means that the if you have a property in the foreign, and the foreign government has also taken some rate, tax and cess, you are also allowed to take the deduction of that while calculating the double taxation relief questions. You are going to fill these things. Okay. Now, in case where the firm uses premise owned by a partner, and rent paid to a partner will also be allowed as deduction to the extent it is reasonable and not excessive. Like if there is a partnership firm who is using the property given by the partner on rent, and the firm is paying the rent to the partner, so it is allowed, but up to the fair market value. If he is charging appropriate, reasonable and not accessible, so it is allowed as deduction. Otherwise, the excess whatever they are charging will be disallowed. Okay. And now the premises used partly for business and partly for other purposes shall be proportionately allowed. Like whatever you are charging, whatever you are using for the business purposes, we shall be allowing it. Otherwise, we shall not be allowing it. This completes your section number 30. It is not as much important. That is why I have gone in a little bit speed. Now coming to section number 31, what does it says? See, as per section number 31, which is also approximately the same section, talks about occupied as a tenant or occupied as a owner. Okay. So insurance premium paid allowed to both, cost that is a revenue nature allowed to both, capital receipt it is also not allowed under the section number 31. But see, the same is for the owner, the treatment is same, that we shall be capitalizing such cost in the asset cost, that is a machinery, plant and furniture, and the depreciation can be claimed on that particular amount. But for the tenant, what they have done, that they have done that it is not allowed under section number 31. And in the section number 30, there was a section, there was a deemed provision na, in explanation number 32, it shall be deemed building and you can take the depreciation, the tenant can also take the depreciation. The same thing is not there in section number 31. So whatever the capital repairs done by the capital tenant shall be a dead loss and there will be no deduction allowed to him. And for the rent and hire charges, which is not there in the under the section number 31. So to claim the deduction of rent and hire charges, which should not be allowed under section number 31, because the section number 31 does not talks about it. So the party who want to take the deduction of it shall go under the section number 37. If he fulfills the condition of section number 37, then he will get the deduction of that particular amount as well. Now see the important notes. Read those important notes first. You will be able to understand it very carefully. Like, repairs include renovation, renewal or renovation of any asset, but not replacement or reconstruction. See, replacement and reconstruction is what is a major thing. Okay, so these are not covered under the repairs part. Okay, insurance premium, like you have not taken the insurance premium from a life insurance corporation or any other insurance company, but you have taken an insurance from a trade association. Like, we have paid a premium to the trade association, and the members of all the members of the association paying the premium to the trade association, and the trade association is promising them that if there is a loss, if there is anything loss happen to your property, we shall indemnify that particular loss. If that is a kind of thing, that insurance premium can also be taken from a contribution in the form of contribution to the trade association, which undertakes to indemnify the members against loss. This is also allowed as deduction. Okay, yes. So the machinery which is partly used for business and partly used for other purpose, the AO shall be determining what should be the amount of deduction should be given to them. And now the word used, here we see na, machine used partly for the business purpose and partly for the other purpose. So what does it used meaning? So they said it should be taken in a wider sense. It should also take into account the active use as well as the passive use. The both the kind of uses shall be applicable, but it is in the normal sense. But they have given they have also given a proviso that insurance and repair charges of the assets which are owned by the owner but have not been used for the business during the whole previous year would not be allowed as a deduction. Means, if there is a insurance and repair charges of any asset, okay, which is owned by the assessee, but that particular asset is not owned by is not used by the business, not used for the business for the whole previous year. So whatever the insurance and repair charges you have paid now, we will not give you the deduction of those, because you have not used that particular asset for whole of the previous year. Understood or not? If you have used for one or two times as well, we shall be taking it as a passive use or active use, and we shall give it the deduction. But if you are not using at all, then sorry, we are not going to give you the deduction. Now the deduction allowable under this section is only for the current repair. For the current year expenses, we shall be allowing it. If you are paying anything for the thing which is already accrued in the earlier years, now but you are paying in this particular year, we shall not be going to give you the deduction. When as well it is eligible for section number 37(1), you can take the deduction under section number 37(1). Then also we are not going to give you any kind of deduction in this particular thing, because we shall only be giving the deduction for the current year and not for the previous years. Understood or not? Tell me this first. Tell me this first fast. Understood this thing? Shall I move forward? Okay. Now coming to section number 32, that is a depreciation. That is depreciation. See, in the class 11, there were two methods of depreciation. Okay. First is WDV, second is SLM. The SLM was easy, and we used to just pray that please, if there is a question of depreciation come, kindly it should come with SLM. In class 11, we used to say that. And WDV was a bit tricky because the calculation part increases, so we don't want the calculation of WDV, so we don't expect the question of WDV in class 11th. But the time changes. But the time changes. The change is the only constant now. The change is the only constant now. That is why the time changes, and you came in CA. That too in CA final. That too in CA final. Where you will see that WTV is good. Please God, do not give us the question of the different kind of calculation in the case of SLN method. Okay. For this purpose, you will say that please God, only give the question of SLM, don't give the question, sorry, only give the question of WDV, don't give the calculation of SLM, because there is a different kind of calculation there. See the nature of beauty, the beauty of nature. Understand it? The change is the only constant. Understand this? This is how, and we shall be starting with the depreciation as per the WDV method. And SLM will also, SLM will be allowed only for the entities which is mentioned there, but WDV is allowed generally. Income Tax Act will generally allow a depreciation on a WDV basis for some kind of the entities, for the power generating entities. They have given what? They have given the SLM method option as well. Understood or not? Tell me that. So we shall be moving ahead with the depreciation under the WTV method. Section number 32, 1, 2. Section number 32, 1, 2. Okay. Now we should be moving ahead with depreciation. Okay. Fine. Yes. So after completing the yesterday's part, okay, now we are moving ahead with the depreciation under the WDV method. Okay. Now we have seen there are the depreciation method which is given to the companies are SLM method or the WDV method. WDV method is allowed generally, but for the SLM method you have certain conditions to fulfill. Okay, we will see the SLM method later on, but today what we are going to start with the WDV method. Okay. So, whereas in the WDV method, the depreciation under the WDV method, we have to understand certain things. So, first you need to understand the certain things in the board notes, and then we shall be reading from the notes. Understood or not? Tell me this first. Yes. So, now understand it very carefully. Okay. You have to write it down as well along with me. Otherwise, the board note shall also be available with you. Now, see, to claim the depreciation claim is to be mandatory. Okay, it is a mandatory thing that you need to definitely claim. Okay, it is not an option to claim the depreciation. It is a mandatory thing to claim. You need to claim the depreciation. Why it is mandatory? Why it is not optional? This is a part of a regular course. We are not talking about this. This is a revision class where we will be completing the course first. Okay. Now the depreciation is to be calculated on a block of asset basis. Block on asset basis. See, in the CA final, either in the CA final, oh sorry, CA our foundation, okay, 11th, 12th, these are the things where you have studied that there are a certain kinds of method of depreciation where they usually, or in the companies act as well, usually they give the depreciation on the asset basis and on a day to day basis. But here in this particular thing, what they are doing, they are giving the depreciation as on the block basis. They do not want to do the hard work, they do not want to do the hard work. So what they are doing, they are making the blocks of a certain kind of assets which are same or similar in the nature. Okay, like if there is a plant and machinery, if you have 10 plant and machinery, so they will be considered it as a whole one block. If there is a buildings, then they will be considered it as a one block. If there is a intangibles, they will be considered it as a one block. Okay, so all the intangibles that the company have, whether it is patent, know-how, technical rights, or any other rights as well, okay, everything will be contained under the intangibles box. Okay, in this particular box is now going to be what depreciated. Like if the rate is what 15% for the plant and machinery, it is going to be depreciated at 15%. If it is 10% for the buildings and 25% for the intangible, whatever the rate is given there, it must be depreciated by that particular rate itself. So this is the concept of block. They are not going on the basis of asset by asset, but they are going on the basis of block assets. Okay, understood. Now can you understand this thing? Now we shall be moving ahead to understand that depreciation on the block depreciation on the block can only be calculated when the block value is not negative at the end of the year end. It is not negative, and the block is in existence, if the block is existing, like the plant and machinery. If we talk about the plant and machinery block of asset, so the plant and machinery is existing, yes, and the value of the plant and machinery is not negative, then only the depreciation can be claimed, and then only the depreciation can be claimed. Now understand one more thing: the depreciation na, it is calculated based on active basis or the passive basis. Both is allowed. Active means what? If you are using it regularly. But the passive means what? They are ready to use. But they are not used. Okay, they are ready to used but not used. They are ready to use but not used. What does it mean? See, usually the depreciation shall be available when the asset was put to use. Means the asset is now using, the use of the asset is now started. But there are certain conditions where the passive mode of application is also allowed, whereas you can claim the depreciation, which is known as what? Ready to use. Means the asset is not put to use, it is not actually using, but it is ready to use. We can use it whenever it is needed. Like for an example, the fire extinguisher. See, to use the fire extinguisher, I am not going to burn my factory. Understood or not? So that is why the fire extinguisher is a need that we need to install in a factory. So that is why we have installed it. It is a part of a plant and machinery, but it is not ready. It is not put to use. We have not actually put to use that particular asset, but it is ready to use. Whenever it is needed, it is going to be applied and we can use it. Okay, so in that particular case, there are certain cases where the ready to use basis is also allowed as deduction. Tell me this first. Understood? Yes. Shall I move forward? Yes. Now understand it very carefully that depreciation is allowed. Depreciation is allowed to the beneficial owner. Is allowed to whom? The beneficial owner of that particular asset. Okay, the beneficial owner. What does that beneficial owner means? See, suppose there is a car. Okay, car is owned by Vaibhav Bansal. Okay, it is owned by whom? Vaibhav Bansal. But the car is using, suppose, Adarsh Bansal. Who is using the car? Adarsh Bansal. Who is owning the car? Is the Vaibhav Bansal. So he is the owner. But who is the beneficial owner? Who is getting the benefit out of that car? So he is Adarsh Bansal. So this is known as what? Beneficial owner. He is known as what? Beneficial owner. So in the case of a depreciation, the beneficial owner is going to claim the depreciation. He is going to claim the depreciation. Now, but understand it very carefully. There are two cases. Understand it very carefully. There are two cases. First case is of lease of an asset, and second case is of hire purchase. Do you understand the difference between the two? Okay, understand? Okay. In the case of lease, always the depreciation is to be claimed by lessor. Okay, who is giving the asset on the lease, he will going to take the depreciation benefit. But in the case of hire purchase, the hire purchaser going to take the depreciation from the day one. Okay, from day one. Understand it very carefully, because we have to see the two things, that is a usage plus ownership. If someone have the usage plus ownership, both the things is there, then the depreciation can be claimed. That then the depreciation can be claimed. I hope you are recalling all those things. Are you, I hope, are you recalling all those points? Now shall we move forward? Yes. Now depreciation is, now understand it very carefully. We are going to complete the depreciation part by this explanation itself. Okay, depreciation is going to be allowed on an actual basis. Okay, actual cost basis. What is the actual cost? That we will see in section number 43 1. Whatever will be the actual cost, whatever will be the actual cost, okay, there on that particular asset. See, we have said na, this is a block of asset, okay, which is a block of asset, that is a plant and machinery, means there is a plant and machinery inside that block. Yes. So what is the cost of that asset? What is the actual cost of this that asset? So we have seen that the cost of purchase, whatever the cost of purchase shall be there, the installation charges will be there, there will be some other charges as well, okay, and there will be less of subsidy. If there any subsidy received by any other party, then it should be reduced from it. So understand it very carefully. If the cost price of that particular plant and machinery was 10 lakh rupees, suppose the cost price of that particular plant and machinery was 10 lakh rupees, but the installation charges was applied for 50,000 rupees of the installation charges, but we have received a subsidy from the government of 2 lakh rupees. Suppose we have received a subsidy of 2 lakh rupees, so there will be 8 lakh 50,000 rupees of that cost that will be added in your block of asset, and on that 8 lakh 50,000 there will be a depreciation of 15% every year. So the depreciation will be allowed on the actual cost, and the actual cost is not the cost price but all the adjustment that we understood already. If you have understand the in AS 116, then there is a that concept is already understood by you, and then we will also understand that in the section number 43 1 discussion. Understand, there is a twist in that. What they have said that if you have paid, see, if you have paid rupees 10,000 or more, if you have paid more than 10,000 rupees in a day to a single person, to a single person, then in that particular case, then in that particular case, if it is paid, if paid otherwise than by account paycheck, demand draft, ECS, or any other electronic mode, okay, or any other electronic mode, in that particular case it is not counted in actual cost. Means if you are paying 10,000 rupees or more in a day to a single person, in a day to a single person, okay, by other than by what, account pay check, demand draft, or ACS, or any other electronic mode. Means if you are paying 10,000 rupees or more to a, oh sorry, 10,000 or more to a person in a day, okay, other than what, account pay check, demand draft, ACS, means in the cash, then it is not going to be applicable, then it is not going to be applicable, and there will be no deduction, depreciation shall be allowed to them, because it should not form part of your actual cost. Understood or not till then? Tell me this, understood or not? Then there is another discussion, then there is another discussion, that is of depreciation. There's a concept of depreciation. Understand it very carefully. What does it says? It says we are not going to check every asset days usage. We are not going to check the every asset usage, whether it is used for 180 days, whether it is used for 150 days, and we need to calculate the depreciation on the number of days. We are not going to all check all these things, because we want to reduce our burden. That is why we have introduced the concept of block of asset. So thereby as well we are saying that we want to reduce our burden. So in that particular case we are saying that, see, we will see the put to use, we will see the put to use for how many days the asset was put to use. If the asset was put to use for 180 days or more, the asset was used for 180 days or more, then full depreciation shall be allowed to them. If it is used for less than 180 days, for less than 180 days, then the half depreciation shall be allowed to them. Okay, and there is a thing that for the shortcut you can see up to the 3rd of October. You can see up to the 3rd of October, that if the 3rd of October is if the asset is acquired and put to use up to 3rd of October 2024, then in that particular case the full depreciation shall be allowed. If it is applied on 4th, the put to use is from the 4th of October or greater than that, then the half depreciation shall be available to them. Now there is a very important explanation which you need to understand. For the purpose of 180 days, we need to see the purpose of 180 days. Then only this is the condition that the asset should be acquired plus put to use both in current, both in the same previous year, both in the same previous year, means if the acquisition date and the put to use date both are in the same previous year, then only you will calculate this 180 days calculation, then only you will calculate this as a 180 days calculation. But understand it very carefully. Suppose I am giving you an example. We have purchased an asset in the previous year 23-24. Understood? Yes. But the asset was put to use in the previous year 24-25. Now tell me when the depreciation will be given, okay, and how much the depreciation should be given. How much the depreciation should be given in that particular case. See, this is very much clear that when we have put to use, then only the depreciation is going to be there. Okay, so when in the previous year 24-25. Now how much should be there? Shall I count 180 days now? Shall I count 180 days now? No. In that particular case, no 180 days criteria shall be applicable. Here the full, that is 100% depreciation shall be allowed, means the full depreciation shall be allowed. No, the full means not the full value. Means if the depreciation rate is what? 25%, so the whole 25% shall be allowed to you. Okay, understood? So this is a very important explanation that you need to understand it. Okay, the usage and if the acquisition date and the put to use date is in the different year, then you do not need to calculate the 180 days calculation. Are you understood this particular point or not? Tell me this. Clear? Shall I move ahead? Yes. The whole explanation of the whole concept of depreciation is now over. The whole concept of depreciation is now over. Understand it very carefully. There is a ICDS limited case law. There is a ICDS limited case law, which is also we have understood that. See, no lesser is still eligible. Lesser is eligible to claim the depreciation. There is a full requirement to claim depreciation, that ownership and usage. We have seen the ownership plus usage. If these are the things, then only the depreciation can be claimed. The same thing is there. Hence, both the requirements are fulfilled in that particular case. They can claim the depreciation. Now, Mysore Minerals Limited and versus CIT, what does it say? It says that whatever the name of the owner of that particular car is, whoever the owner, it is not important who is the owner or in whose name the particular asset is registered. The main purpose is what? Who is the beneficial owner? If the owner and the beneficial owner is different, so the depreciation benefit shall be given to the beneficial owner itself. The registration of name under the Registration Act is not determinative of ownership. Beneficial owner is important, and the beneficial owner is going to claim the depreciation in this particular case. Now, calculation of a depreciation. Now, this is very important. This is very important and very easy. How do see in the 11, 12, what do you want to calculate? See, if you want to calculate the closing WDV of the block, what is the closing WDV of the block? Closing WDV should be the opening plus purchases minus sales. Okay, this is what my closing WDV. This is what my closing WDV on which I have applied the depreciation rate, and this is my net WDV. Okay, this is my what? Net WDV. This is what we are doing here itself. See, opening WDV is what? Opening. This is what we have purchased. That's the actual cost of the asset acquired during the previous year. They have bifurcated it, whether it is applied before 180 days or 180 days or more, or it is not applied at all. All these three conditions we have seen. Now, money payable, that is the selling price of the asset if the asset is sold. Okay, if the asset is transferred in the slump sale, we will see in the capital gains. So it is also a sale. So it shall also be reduced. Now we will get the WDV on which we will take the depreciation, and this is what the net block of asset. Understood or not? Tell me this. This is the same thing that we have already studied in the very starting of our commerce, class 11th and 12th. Understood? Yes. Now, then coming to the rates of depreciation part. Coming to the rates of depreciation part. What we are saying, see, it is very important to understand all these things. Buildings is generally is to be depreciated at the rate of 10%. But if the building is of residential use, except hotels, then 5%, and temporary buildings are going to be depreciated at the rate of 40%. Okay, furniture and fittings is going to be taxable at the rate of, sorry, depreciated at the rate of 10%. Whether it is the electrical fittings like fan, wires, switches, anyone, it is going to be depreciated at the rate of 10%. Now coming to the plant and machinery, just leave these 2 points, we will be understanding it in a later part of it. But ships, vessel, speed post, 20% is going to be the depreciation rate. Aeroplanes, aero engines, 40%. Computer software, 40%. Books including annual publication or used in the library, that is 40%. Pollution control equipment, again 40%. Now windmills, if it is installed before 1/4/2014, then the 15% will be the rate. But if it is acquired and installed after 1/4/14, then the 40% shall be the rate. In normal cases, whenever the question is not clear when it is installed, then always assume 40% of the rate to be applied. Now renewable energy devices is also 40%. Oil wells and other plant and machinery is going to be 15%. Okay, now coming to the motor vehicle. See, there is a concept of motor vehicle. I am not going into the details why this motor vehicle is going to be depreciated in so much technical manner, because this is of a regular batch. We explained this particular thing in a very detailed manner, why all these happen, and what was the situation of the economy that particular time, and what was needed. The whole explanation is then in the regular classes. Okay, but now what we are doing, it's here, that is a motor vehicle. Just understand this as per just for the revision purpose. Okay, now motor vehicle, listen to me very carefully. If it is for the own use, or if it is for the commercial use, okay, like you are doing what, running them on hire, running them on hire. Understood? Now for the normal use, the rate is what, 15%, but here the rate is what, 30%. Just understand it, the difference of the two. If we are using the motor vehicle for own use, then the depreciation is going to be 15%. And if we are going to use it for the commercial purpose, then the depreciation rate is going to be what, 30%. But there is a twist. If any of these purchased and put to use between 23rd of August 2019 to 31st of March 2020, then additional 15% shall be allowed as depreciation. Additional 15% shall be allowed as depreciation. Earlier, see, it was 15% plus 15% means it is going to be now 30%, and this was earlier 15%, sorry, 30%. Now it is going to be what? 45%. Understood this or not? Additional of 15% shall be allowed to you. Tell me this. If it is purchased and put to use between these dates are very important. This need to be understood and this need to be learned. Okay, if you are learning this particular thing, if you are learning these dates, then it is going to be very important for you, because I can test you on this thing. Okay, if the motor vehicle is purchased between the 23rd of August 2019 to 31st of March 2020, then the additional 15% is going to be applied in that particular case. Have you understood this thing? Tell me, have you understood this thing? Shall I move forward to you? Tell me. Shall I move forward? Yes. Now, coming to the, we have seen everything. We have seen the, see, in the case of computers, na, in the case of computer and computer software, the computer accessories are also covered here, and it is going to be taxable at the rate of 40% itself. EPABX and the mobile phones, they are not computers, hence 15% shall be the depreciation rate. Okay, and everything we have already discussed. Everything we have already discussed. Okay, now for the purpose of this depreciation put to use for less than 180 days, we have already seen this as Well, there is nothing to be taught about it. See, for the provision to section number 32.1, that is a depreciation in case of a amalgamation, demerger, and succession. There is an example of ICISM, that is the illustration number 3. This is going to be seen in the question and answer session that I will be giving you in a separate video. The lecture will be comprising of two parts. The lecture will be comprising in two parts. First part is what? First part is basically for the concepts, and the second part will come in the evening, which is comprising of all the questions. So the question answer point in the 316 question, there will be a first question of the PGBP of the Psi Limited, then that will be covered in the question answer session. Understood or not? Yes, there will be covered there. Now everything is clear, but now there is one point that is important, that for the intangible asset, for the goodwill, depreciation shall not be allowed. Depreciation shall not be allowed. On that goodwill, the depreciation is not allowed to you. This is the one thing that you need to understand. Okay. Now everything is clear. Yes. 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 We have seen it. Now coming to the additional depreciation. Coming to the additional depreciation. What they are saying, that if you follow the certain conditions that we will say to you, if you follow the certain conditions, then over and above the depreciation, understand it very carefully, over and above the depreciation, as a one time benefit, we are going to give you an additional depreciation. Okay, it is like a top up depreciation over and above the depreciation which is already given to you. We are going to give you an additional depreciation. So if the assessee is engaged in the manufacturing businesses of any article or thing, or in the business of generation, transmission, or distribution of power, and he has acquired and installed a new plant and machinery. So if you are a manufacturing business, okay, if you are a manufacturing business, or you are a business who is in the business of generation, transmission, or distribution of what? Power. And he acquired what? He acquired and installed the new plant and machinery. Acquired and installed what? New plant and machinery. Old nahi. There is no old plant and machinery. There should be a new plant and machinery. Then additional 20% of the additional of the actual cost shall be allowed as additional depreciation. And the same thing for 180 days, if there if it is used and put if it is acquired and put to use for less than 180 days, then definitely the half depreciation is going to be allowed to them and not the full depreciation. Now but there is certain condition that in that particular case the additional depreciation shall not be allowed to a assessee. What is the case? See, you cannot opt for second hand planter machinery. We have said, you know, you need to opt for the new planter machinery. So the second hand planter machinery should not be purchased. Whether used in India or outside India does not matter. You should not purchase the second hand planter machinery. Okay. Any machinery or plant installed in any office premises or residential accommodation. We do not want to use these assets for your own purpose. We do not want to use this particular asset for your own interest. Okay, what we need that these assets should be purchased for the factory purposes, for that the production can be enhanced in the production, it help directly in the production basis. So if you are using something in your office premises like AC for your benefit, or you are using something for your residential accommodation, these are not the new plant and machinery, and for that no deduction shall be given to you, no additional depreciation shall be given to you. Now if there is any office appliances or vehicle that is a road transport vehicle, then also it is not going to be allowed as a additional depreciation. Or there is a plant and machinery on which 100% cost is taken as deduction, that is section number 35 AD. In that particular case, you know na, 100% depreciation is 100% deduction is already allowed as the cost of asset. So that is why if you have taken already 100% of the deduction, so we shall not give you any other further depreciation in that particular case. Tell me this, have you understood this particular thing? Shall I move forward? Yes. Shall I move forward? Yes. So now the printing and publishing treated as a manufacturing businesses, okay, and it is also eligible as a additional depreciation. Now additional depreciation is allowed only on the WDV method and not on the SLM method. For the SLM method, the only depreciation shall be allowed, additional depreciation is not allowed to them. Now the forklift trucks and the cranes that is used in the factory, see, you have seen the trucks in the or the cranes that used in a factory to carry out any work, to pull any of the suppose the high weighted thing and move on to the another place. Yes, these are the trucks that are used in a factory, then it is also not treated as a transport vehicle and they are eligible for the additional depreciation. And now see, we have seen the word. What is the word is? The word is plant and machinery that should be new. If it is assembled machineries na, then also it is considered as a new plant and machinery and there will be an additional depreciation. Now it is available only for the plant and machinery and not for the furniture and fixture. It is already very much clear na, the plant and machinery what is written, so the depreciation shall only be given to the plant and machinery and not to the furniture and fixtures, and this is only a one time benefit that I have already told you. And the additional depreciation shall not be allowed in the special regimes and shall not be allowed in the special regime. Understood or not? Do you wanted to read once? Take 1 minute and read everything. Take 1 minute and read everything. Yes. So move on. Okay. Now, coming to the unabsorbed depreciation, what does it mean? What does the meaning of unabsorbed depreciation? See, if there is in some year my profit is what only 2 lakh rupees, but the depreciation claiming is mandatory, but my depreciation is what 3 lakh rupees. So whether I can claim a loss of 1 lakh rupees? No, you cannot claim a loss of 1 lakh rupees. But instead of this, what you can do, out of the 2 lakh rupees of the profit, you can adjust the 2 lakh rupees of the unabsorbed depreciation, but the balance 1 lakh rupees of the unabsorbed depreciation shall be carried forward. Now, unlike the business loss that can be carried forward for 8 years, this can be carried forward for infinite number of years. But in the next year or in the subsequent year, what should be the sequence of setting of this particular unabsorbed depreciation? So for that particular thing, you need to understand it very carefully. First thing, you need to set up what current year depreciation. Why? Because it is a mandatory thing. Because it is a mandatory thing, you need to claim it anyhow. Okay. If then also the profit is left, then you can claim what unabsorbed, oh sorry, brought forward business loss by because it is for the limited year only. It is allowed for the limited year only, that is of 8 years. So the set of that particular thing is necessary. Now if also the profit is left out, then you can claim what the unabsorbed depreciation. Understood or not? Okay. Now what they are saying, that see, for the unabsorbed depreciation, unlike the loss written in the loss written, sorry, in the written, when the loss is not filed. Okay. If the return is filed and loss is claimed, then okay, you will get the loss. But if the return is not filed and there is a loss, so if the return is belated, if the return is not filed on the due date and if the return becomes a belated return, then there will be no carry forward of the loss is allowed to you. There will be no carry forward of the loss should be allowed to you. But in the case of unabsorbed depreciation, that also it is allowed. Whether the return is filed on time or does not file on time, unabsorbed depreciation claim is mandatory. You shall be allowed that particular thing. Understood or not? Yes. Okay. Now unabsorbed depreciation can also be claimed whether the business is no longer existing, if the business is shut down, if the business is dissolved, closed, then also you can get the unabsorbed depreciation to set off from the business. Understood or not? These are the two things that you need to understand, but there is a twist that unabsorbed depreciation can be set off from any head of income except salary. From salary you cannot set off the unabsorbed depreciation. Now coming to the WDV method. What is the WDV method? See, the actual cost minus the depreciation that is actually allowed to them shall be what the WDV. This is all. This is what the WDV is, not carrying value. It can never be a negative. If it is negative, then definitely the depreciation shall not be allowed in that particular case. Understood or not? Yes, understood or not? Now, moving ahead. If there is a case of succession of a business, so whatever the WDB in the hands of successor will be transferred to the WDB in the hands of a party succeeded to, means a predecessor. Predecessor. Okay. WDV in the hands of successor will be in the hands of predecessor. Understood? Whatever is in the predecessor's hand will be given to the successor. Understood or not? Tell me this first. Now, moving ahead. Whatever is important, we are just dividing each and every concept of that particular thing. Okay, not going in that much of detail because it is a revision class. I am again and again reiterating that point because it should be known to you that you must understand these all the concept earlier as well. Now we are just revising all those things. Okay, now coming to the actual cost definition. See whether we have completed this particular definition or not. Tell me this, whether we have done all these things or not. Majorly the things have been done or not, it is already known to you. Just read the actual cost definition and everything, giving you 1 minute. Read these things whether we have done or not. Read these things. Yes, clear. We have seen all these things. See, we have seen all these things. We have seen that the cost of purchase plus installation charges is there, transportation expenses to put the asset into a working condition. All those charges will be capitalized in the cost of asset. Yes, the trial run or the test run expenses, if there is expenses, is also to be added up. Taxes and duties shall only be added up if the ITC is not available to it, and for the acquisition of any asset you have taken the loan, and if you are paying the interest on that particular loan, so whatever the interest you are paying from the loan taken amount till the date when the asset is actually put to use, all this particular interest shall be capitalized in the books of account. This is also seen in the borrowing cost in AS 23, if I am not wrong. Correct? Yeah, all those things here. Is it clear to you? Yes. Now, less in the less part. See, if there is any amount received on the sale of a trial run product, you all know it is also a part of India 16. Yes, in day 16 you see both these things 16. Okay, and if there is a subsidy in government grants received that we have already talked about, okay, it should be reduced. We have already talked it about. Now, coming to the actual cost in special cases, there are certain special cases. In these cases, that the actual cost is different. Okay, understand it very carefully. If the asset was previously used for the scientific research and now it is put to use in the regular business, see, in the if it is used for the scientific research, then definitely under section number 35 100% reduction has been claimed as a cost of, okay, deduction. Now if the asset is coming to the regular business, then definitely you have already claimed the 100% deduction in the section number 35. So we are not going to give you the additional deduction. That is why the actual cost is going to be nil. Why is this is going to be nil? Because if, see, if there is a part is some, if there is any value in the actual cost, then it will add up in the block of asset, and in the block of asset the depreciation will be given. So whatever the value, on that value of the scientific research asset is also going to be get the depreciation, but we do not want to give them the depreciation. Why? Because they have already taken the 100% deduction earlier as well. That is why we have kept the actual cost as nil. Now see, point number 1a, what does it say? Stock converted into capital asset and used for the business or profession. If there is a stock which is converted into a capital asset and you are using it business, using for business or profession, means what? See, if I am a Lodha construction business, okay, understood, I have constructed a building, and the flats I constructed approximately 100 flats to sell. Okay, this is my what, stock in trade, because I use in this is my business only, where I construct the plots, where I construct the buildings and sell it out. Okay, sell the particular flats. Okay, but out of the 100 flats I sold 99 flats, but one flat I made it my own. Suppose I made it my own business. Okay, my own business office. So it is now my stock in trade is converted into a capital asset. So in that particular case, the fair market value as on the date of conversion is going to be my actual cost of asset. Understood? Now, asset acquired by way of gift, will, inheritance, that is received from your father or received from your ancestors, then in that particular case what does it happen? Actual cost to the previous owner, means to your father or any ancestor, less depreciation actually what they are allowed to them. So what is the WDV in their hands need to be received as a actual cost by you. Now if the asset acquired with an intention to claim higher depreciation, if there is asset acquired with the intention to claim higher depreciation at a higher rate than the FMV, if the original value or the original fair market value of that particular asset is 10 lakh rupees, but you have acquired it in 20 lakh rupees because you want to in the higher depreciation in that particular case, and there is a transaction between your between you and the seller, that the 10 lakh rupees will be come to you as a black money and in the cash or some other things. Okay, in that particular case the AO will determine the fair market value, and with the approval of the joint commissioner, usually they will take the actual cost as the FMV of the asset. Now if the asset is sold and now you are reacquiring that particular asset, so the lower of WDV at the time of sale or actual price of reacquisition is whatever the lower is, you will take as the actual cost. See, in these particular things now, I can just narrate all these things to you. This is not as much relevant for the exam perspective, because usually ICA does not ask from these particular points, but they can ask it. That is why we are going to take care of all these points, but I cannot go in detail of any of these things, otherwise this lecture is going to be of 10-12 hours. Okay, that is why I have a restriction on it. So whatever is not much important for your exam point of view, I have to make it a bit quicker. Okay, understand it very carefully. Clear? Now, asset purchased and leased back to the same person. If the asset is purchased and leased it back to the same person, then in that particular case, the WDV of the previous owner, that is a lessee, will be taken as what? The W as the actual cost. Now, building that was used for other purpose and now brought into the business, means if the building was used for the personal purpose, not the stock in trade. They are not talking about the stock in trade. They are talking about the other purpose. See, if the stock in trade is converted into my capital asset of the business or profession, then the point number 1A shall come. But what they are saying, that is, it is specific to the building itself and was used for any other purpose. It is used for any other purpose. Now it is coming to the business. Now it is coming to the business. In that particular case, the original cost of the particular asset when it was purchased minus the notional depreciation till date at current depreciation rate. It is very important that at the current depreciation rate. See, suppose if the asset was purchased in 2011, it does not matter what is the rate of the depreciation in the 2011. We will not depreciate it from the level. Okay, we will only depreciate it what is the current rate of depreciation. So suppose in the 2011 the depreciation rate for the building is 5%, but now in the year 2024-25 the depreciation rate now becomes what, 10% for the case of the buildings. So we will depreciate for the whole year from 2011 to 2024-25 at the rate of 10%. Understood or not? Sir, why it is a notional depreciation? The depreciation has already been claimed now. No, because for the other purpose, if it is for the personal purpose, so for the case of personal purpose, can you claim the depreciation? No. So you have not have claimed the depreciation. That is why they have used the word notional depreciation. That we will assume that you are using that particular asset from the business point of view since inception. So then only we will calculate the whole depreciation till now. That is what the notional depreciation is. Now, see, these three cases are very much similar. If the capital asset is transferred by holding company to 100% subsidiary company or 100% subsidiary company to holding company, in that particular case, the WDV means the opening WDV of the cost or to the transferor, which transferring the asset shall become what? Shall become what? That actual cost in the hands of a transferred, in the transferee. Understood? Or if there is an amalgamating company which is amalgamated to the amalgamated company, okay. If there is a company which is amalgamated to another company, so in that particular place, in the amalgamated company, whatever the cost of the opening WDV of the in the hands of amalgamating company means which company is going to be amalgamate. Okay, that is going to be the actual WDV. Same in the case of resulting or the demerged or the resulting company. Understood or not? Tell me this first. Clear? Now, if the asset is acquired out of the borrowed fund, we have seen this already. Point number 8, we have seen this already, that the interest up to the first put to use shall be the form part of the actual cost. Now, GST customs, okay, in that particular part, what does it say? If it is ITC is not available to claim. If the ITC is not available to claim, then it is to form part of the actual cost. Otherwise, it not form part of actual cost. Understood? Now, government grant or subsidy, we have seen that we have to reduce it from the actual cost. Okay, if it relate to any asset, then reduce it from the actual asset. Now, if the asset brought into India by NR for use in his business or profession, if there is any asset which is brought into by which is any asset into India by NR for use in his business or profession. In that particular case, what will happen? In that case, actual asset minus the depreciation that to be calculated. In the case of NR, see, understand it. In the case of NR, what is happening? This is the case of NR. Means any asset which is brought into by India by whom? NR, and which is used in their business or profession. So the actual cost of that particular asset minus depreciation calculated in the rate in force as if the asset was used in India from the date of acquisition. Means the depreciation for respective years will be taken. Okay, above explanation, point number 5, we have seen that the current depreciation shall be taken. Here I have written that, like explanation number 11, that I have given a clear explanation, clear difference, that in point number 5 you are going to take the current year depreciation rate, but in point number 11, when it is a case of non-resident, then you have to take the depreciation rate of respective years. You cannot claim a direct depreciation rate of current year. No, you have to claim it for the every year. That for the 11, for the 2011, if there is a if there is a depreciation of 5%, then you have to claim for the 5%. For 12, if it is 5%, you can claim it 5%. But above 2013, the rate is now 10%, so you can claim it only 10%. Okay, so for the respective years you have to calculate, not the blanket the current year rate. Understood or not? This particular difference. Understood? Now, if there is a corporatization of what recognized stock exchange means, the recognized stock exchange was earlier what AOP and BOI, and now it is becoming what a company. So whatever the cost or WDV in the hands of AOP and BOI shall become the actual cost in the hands of that particular company itself. Now, if the actual cost which already allowed as what section number 3580 deduction, then the actual cost shall be treated as what? Nil. The actual cost shall be treated as what? Nil. For the explanation number 8 and for the explanation number 10, there are certain notes. You need to just read those notes. It is important, but just read those notes. It is just if in case there is some adjustment in the question, then you will be able to solve it. But it is just a read and go wali thing. Okay, now read it. Take 2 minutes and read it very carefully. Take 2 minutes and read it very carefully. Now come to the depreciation under the SLM method. Read it very carefully. See, we have seen the depreciation as per the WDV method as of now. Now we are going to see with the WDV with the SLM method. See, this is a bit tricky method, okay, but a very less used method. Okay, in the ICA SM, there is only one question, and in the exam, I don't think there is any questions in respect of the SLM method. Okay, see, the SLM method is like an optional method. If the assessee wants to go with the WDV method as well, he can go. Whether it is written for the assessees where the SLM method is given as option. If they want, they can go for the WDV, but if they want, they can go for the SLM. Yes, but for the WDV method, okay, for the assessees which is written here, other than those assessees, if they want to opt for the SLM method, whether they can opt, no, they cannot opt. Okay, SLM is open for these assessees which are going to be taken care now. Now see, an assessee who is engaged in the business of generation and distribution of what power. What they are saying, that either you are in the business of generation, or you are business in the generation or distribution of what power. Either you are only generating it, or you are generating plus distributing it what power. Okay, in that particular case you can claim the depreciation either with the SLM method or the WDV method. Okay, the option should be exercised before the due date of filing of return under section number 139(1), and if it is first exercised in any year, then you cannot subsequently change the method. Understood or not? Yes, you can understand it. Now these 2 points we will read it, but we will read it understand after understanding this particular example. After getting recalling all these examples, you will be able to understand what is written in point number B and point number C. I'll give you to read, but for that, just listen to me very carefully. What is the example says, that the actual cost of the asset is what, 1 lakh rupees, whose 10 years life is this. Okay, and after 3 years it is sold for these three amounts. Okay, these are the three cases. Now what we understand it. Now first we need to calculate the WDV. If this is the cost of 1 lakh rupees for the year 10 years, so 3 years depreciation shall be what, 30,000 rupees. So means the WDV shall be what, rupees 70,000 of that particular asset. The WDV shall be what, 70,000 rupees of that asset. Yes, now the WDV is 70,000 rupees as per the books of accounts. Now it is sold for what, 50,000 rupees. See, if I assume that if any asset is sold in the market, so it is a open market value, or you can say what, a fair market value, correct or not? So it is a fair market value. Okay, so you have claimed only 30,000 rupees of depreciation. That is why the WDV came to 70,000. But now the actual market price of that particular asset is 50,000 rupees. Means the government is saying to the assessee, you have claimed less depreciation, you need to claim more depreciation na? Because the actual price in the market of that particular asset is what, 50,000 rupees, but you have claimed only 30,000 as depreciation, and the WDV is what, 70,000, because you have claimed less depreciation. If you claim more depreciation of 20,000 rupees, so the WDV in the books of accounts shall also be 50,000 rupees. So that is why they are saying that you have claimed the less depreciation, so you have to claim more depreciation of 20,000 rupees. So in that particular case, what they are saying, that you have to calculate you have to take more depreciation on the sale. That is why it is known as the term as what, terminal depreciation. Means on the sale the government is giving you more depreciation. That is why while terminating the asset, you are going to get what, additional depreciation. So addition means apart from the normal depreciation at the time of sale, so the terminal depreciation shall be given to you. See, in this particular case, point number A, 20,000 is going to be a terminal depreciation. That is what, whatever the loss it is coming, it is going to be a terminal depreciation. Now if I say it is a loss, it is a profit, there is no case. But to understand, if you understand the logic why the terminal depreciation is coming, then you will able to understand these things easily. Now second case, the WDV is what, 70,000 rupees. I sold it for 80,000 rupees. Means that my fair market value in the market is 80,000 rupees for that particular asset, but it is in my books of account is 70,000 rupees. Means I have claimed excess depreciation of 10,000 rupees. Tell me that I have claimed excess depreciation in my books of 10,000 rupees. Yes. So the government want to charge it. The government want to charge it. So that is why the word is what, balancing charge. So the balance amount, that is 10,000 rupees that you have excess, that you have taken the excess depreciation of 10,000 rupees, that balance 10,000 rupees is going to be a taxable thing. That is, we are going to charge it as a PGBP under section number 41. Under section number 41, we are going to charge this income. Understood or not? Tell me this first. Yes, so this is also clear. Now coming to the point number C. It is an important point. It is an important point. See, what does it says? It says, see, my WDV was 70,000 rupees. The actual cost of the asset was 1 lakh rupees. Now it is sold for 1 lakh 20,000 rupees. Means the selling price also surpasses the actual cost of the asset. The selling price surpasses the actual cost of the asset. Correct or not? Yes, in this case it is correct. So the government is saying that, see, means this means the asset is not a depreciable asset. Oh. The asset is not a depreciable asset like that. The asset is not a depreciable asset because the 70,000, the value of 1 lakh rupees of an asset should decrease instead of increasing. But in that particular case, the value is increased because it is sold for 1 lakh 20,000 rupees. Okay, so in that particular case, from till here to here means you have claimed the 30,000 rupees of excess depreciation that should not be claimed, because this is not this is like a asset which is not a depreciable asset. In fact, it is not it is a depreciable asset. In fact, it is a depreciable asset, but the government is saying that you have claimed the excess depreciation. Yes, so this excess depreciation of 30,000 rupees, the same as a balancing charge, will be there in 41 under section number 41. It is treated as what? PGBP. It will be treated as what? PGBP. But listen to me very carefully. But in this particular case, from 1 lakh to 120, can you feel the capital gains? Can you feel the capital gains? Yes, the value of the asset is what? The value of the asset is what? 1 lakh rupees. The value of the asset is for 1 lakh rupees. Now it is sold for 1 lakh 20,000 rupees. Means there is a profit of 20,000 rupees on sale. So it is going to be taxable under the section number 50A capital gains. It is going to be taxable under the section number 50A capital gains. Can you read this? Can you read these 2 points first? These are the examples same I have given to you. Okay, can you read these 2 points first? Read it. Yes, have you read it? Now, now read these 2 points. Now read these 2 points. Now you will able to understand all these 2 points. Read it. Yes, done. Shall I move forward? All these 2 points understood by you clearly. Special provision in case of transfer of a depreciable asset. Okay, if the few of the assets are sold, see, there are two conditions. Understand it very carefully. There are two conditions. First, see, this is the only thing that you need to understand in this particular whole section. Okay, if the transfer of one or more capital asset is done but not the whole block of asset is not ceased to exist, means the whole block of asset is not sold, only one or more of the capital asset was sold from that particular block. So you are in the case number one. But if the whole block of asset is ceased to exist, then you are in the point number two, means it is like a sold of all the capital asset. Understood? Now see, in the normal case, you need to calculate the capital gain. In The capital gain, what is the formula? That the fair value of consideration shall be the first thing, less expenses on transfer, less cost of acquisition. Correct, less cost of acquisition. In the capital gain, what is the formula? What is the formula? Capital gain, in the calculation of capital gain, fair value of consideration shall be reduced by expenses on transfer. Okay, then it will comes as a norm, then it will come as a net consideration, and after that you need to reduce what cost of acquisition, and you will get the capital gain amount. Same thing is written here. See, full value of consideration, yes, less aggregate of expenses or transfer, minus, yes, opening WDV plus actual cost shall be what? The cost of acquisition. Whatever the asset we have, it's just the cost of acquisition is that. Okay, we shall be reducing it, that is the opening WDV plus whatever the asset we have acquired during the previous year. You will get the short term, but in this particular case always the short term capital gain will come. In this always the short term capital gain will come, never the short term capital loss can come. But in this particular case always the short term capital gain can also come, or short term capital loss can also come in this particular case. Understood or not? Tell me this first. Clearly understood? Okay. Clear? Shall I move forward? Yes. Now, coming to section number 33 AB. Now, here from here onwards, the important sections are now going to start. Okay, there are two or three questions that are very important, two or three sections that are very important. Otherwise, all the sections then it is going to be a repeated work. Now, coming to section number 33 AB, which talks about the deduction in respect of a T development account. Means if there is any SSE who is engaged in the business of growing and manufacturing of tea, coffee, rubber in India. Okay, and he has deposited any amount with the NABARD or in the deposit account. Just wait a second. In this particular question, there is a question that need to be solved. Let me do one thing. For the question number 33 AB, for the section number 33 AB, I shall be with the question of there is a Gomti Limited question. Just let me check. If, just a second. English. This is 316 important question. No? Just a second, just a second. Give me a second. Yes. Question number 3. We will solve the question and answer in the second part now. So in the second part, while solving this question, I shall be explaining the whole concept. Okay. So section number 33 AB will be explained in while solving this particular question. Then there will be a linking. If I will explain today, okay, and the lecture of the question answers you will see tomorrow or the day after tomorrow as per your convenience, so you can be confused little bit. So while explaining the section, I shall be solving the question as well, so you will get a brief idea of those things. Understood? So this is the section that you can take it that you can put it on hold. We shall be uploading the question along with the concept. Okay, so you can take it as a hold. We will explaining it. We will explain everything like this. We will explain everything. The same thing, section number 33 ABA. Okay. The same is the section number 33 ABA. You can read it and you can wind it up because it is very less important. Very less important. Even you can, I cannot say that word, but you can do that. Okay, it is a very less important, but exactly same, just like one or two changes. Like first change is what I am just marking up the changes. Okay, I am just marking up the changes that why after reading the 33 AB you will be able to understand this particular thing. Okay, the deduction this amount is changed. Okay, and rest all the provisions of section number 33 AB is going to be same. Okay, these two or three things that you need to be understand, otherwise everything is same, and it is a very less important section as well. You can do whatever you can do whatever you want. Now coming to section number 35, which is an important section. Understand it, which is an important section. What does it say? It says very easily that if you have done any expenditure on the scientific research, if you have done any expenditure on the scientific research, see, in this box, we will be talking about the assessee having the business of scientific research. assessee is having the business of scientific research. But in the second part, we will be seeing that the assessee is not having the business of scientific research, but he is contributing in some entities or in some institutions who are doing the scientific research work. Who are doing the scientific research work, the assessee is just contributing it. So here the main business of the assessee is not the scientific research, but in the upper part, the assessee's business is what? The scientific research. So there is a difference between the two. First, this difference is clear to you. Now, see, section number 35 says that whether is a capital expenditure, whether is a revenue expenditure. See, I have explained you earlier as well in the starting of the chapter that the revenue expenditure shall always be allowed in the capital in the PGBP section in the PGBP chapter. But for the capital expenditure, when it is explicitly written that the capital expenditure shall be allowed, then only it is going to be allowed. Now, section number 35 says there said this very explicitly that capital expenditure shall also be allowed, and both shall be allowed what? 100%. Both shall be allowed as 100%. Whatever the capital expenses you are doing, all shall be allowed as 100%, but except land. The capital expenditure done to acquire the land shall not be allowed as a capital expenditure, and same for this amount as well. Understood? First thing. Now, if you have done the expenditure after the commencement of your business, then in the year when the expenditure is incurred, you can claim the claim the section number 35 deduction. Whenever you expended the amount, you can claim the deduction in that particular year itself. But suppose you have done the scientific research work before starting of a business, and up to the 3 years before starting of a business. So for those 3 years, whatever the expenditure you have done, we will give you the deduction in the year of commencement of a business. In the year of commencement of a business, capital expenditure all will be allowed, but other than the land. But for the revenue expenditure, see, after the commencement of business, every kind of revenue expenditure shall be allowed to you. But before starting of the business, up to the 3 years before starting of the business, prior means the prior to means before commencing the business, the 3 years prior to the commencement of the business, only the salary and the material expenses shall be allowed. That should also be approved by the prescribed authority. Then only in that particular case the deduction shall be allowed to you. Now coming to the contribution based deduction, either the contribution is made to whom? National board notified bodies of the central government, like for the scientific research, for the social work, social science, or the statistical research, or you are contributing to a national laboratory, IIT, university, or any person which is approved, which is the person approved by prescribed authorities, or Indian company who's having the main object of scientific research and development. In that particular case, what will happen? What will happen? You will get 100% of the amount as deduction. You will get the 100% amount as deduction. And if you are claiming 100% amount of deduction, so there will be no depreciation in that case, because you have taken 100% amount of deduction. Okay, so no depreciation can be claimed in that particular case. And see, if there is a bill in which the land and building, the amount total of 2 crore is written. Okay, you have purchased the whole land and building for 2 crore rupees, suppose. So in that particular case, there is no bifurcation for what amount the land is purchased and for what amount the building is purchased. So if there is a composite amount sold, composite amount is written in the bill, that in that particular case, what you need to do, you need to bifurcate it in the basis of fair market value. What is the fair market value of the land? The amount will go into the land, and for that no deduction shall be given to you. Only the deduction for building shall be given in that particular case. And if there is a bifurcation already given in the bill, then you can take that particular bifurcation. This is point number 4. And point number 1 and 2 is a very procedural thing that you must not know. If you can read it, otherwise you can go forward, and I am giving you to read it, because it's just a read and go, move forward wala thing. Okay, but I want you to read so that it can retain for you for the longer period of time. If I'll tell you, it will not retain to you. If you will read it, you'll going to retain it. So take 2 minutes, read it, and then we shall be moving ahead. Yes, understood. It is only a procedural part, nothing else than that. Okay, now moving ahead with the deduction for the biotechnology business, it is also a less important section, never asked, and there is no chance to ask as well. But there can be an MCQ, they can ask in MCQs as well. Now, it is important to listen because they can be asked in the MCQ, otherwise, it is not an important section as well. Okay, like 41.3, not at all important, not at all important. Okay, we shall be moving ahead on these sections because this section 33 ABB, okay, ABA, these two three sections are not as much important. That is why we shall be leaving it. But from where I can find it that there can be a chance of asking of MCQs, then I will explain you. See, following conditions are set, if following conditions are satisfied, then the 100% deduction shall also be allowed in all revenue as well as the capital expenditure. Here as well, same like section number 35, they have also said for the revenue and the capital nature, but except land and building. Earlier in section number 35, they have said the land deduction shall not be given, but for the building, can it be given? Yes, it can be given. See, but but listen to me very carefully. For claiming this deduction, the assessee should be a company who is engaged in manufacturing and biotechnology business and whose research is approved by a prescribed authority. Then only 100% deduction shall be allowed to you, except land and building. But there is a point. This is a question point. There is a question which you will find might not be in the 316 important question, but there is a question that for the biotechnology business, land should not be allowed because it should also not be allowed in section number 35 and it is not allowed in the biotechnology business as well. First thing is clear. For the building, in the biotechnology business, 100% deduction is not allowed because they have explicitly said that for the building also it will not be allowed. But for the building, you can claim the deduction under section number 35(1). Okay, so whenever there is a question of biotechnology business, you need not to give the deduction of land, but you can give the deduction of building under section number 35(1)(4). There is a question of ICISM where they have done the same treatment. Okay, because section number 35(1)(4) gives an overriding effect to the section number 35(2)(ab). Understood? And the other revenue and the capital expenditure shall be allowed as 100% deduction. Shall be allowed as what? 100% deduction. Understood? So this is also important. This is also done, which is a less important section. 41.3. Okay. If you have done what? If you have done the SLM method, na, you will be easily understanding it. You will be easily understanding it. We have done it already. Okay. Now, for the 35 ABB and ABA, you can Um, I also don't know what I have written, but you can understand it. Means they are very. They are these are those sections which are never asked by the ICI in that particular sense, and it is also not a testable things. Okay, that is why I am not explaining you all these things because there is a question of 14 marks, which will be which we need to tackle, and these are not the part they can ask in that particular thing. Okay, now coming to the section number 35 CCC. That is what they are saying that the 100% deduction shall be allowed if the company is doing what? Rural development. Okay, means the company is doing that. No, no, no. Company is making a payment. Array. Company is not doing the work of rural development, but the company is making the payment to the associations or the organizations or which is notified by the central government who is doing the work of rural development and it is contributing to the rural development fund. The company is contributing to the rural development fund, then the 100% deduction shall be available to them, and deduction shall not be denied if subsequently approval is withdrawn. See, I have given the payment to the rural development fund or to a organization which is approved by the central government. When I have given the deduction, I have given the fund to them. After few days, their approval is withdrawn by the central government because of any of the reasons. Okay, can my deduction is also be withdrawn because I have paid to them? Can I take 100% deduction or not? Yes, you can claim 100% deduction because you have paid to them when they were approved. Now after paying they are not approved, it is not our headache. Okay, you can take the 100% deduction in that particular case. Now the deduction under section number 35 cca shall be the amount shall not be allowed under any other provisions. Means if you have taken the deduction under section number 35 cca, so that amount shall not be allowed as deduction under any other provisions. Okay, no, if you have taken the section number 35 cca deduction, you cannot take deduction of any other section. That is what they are saying. Now coming to section number 35 ccc for the agriculture extension project. Okay, if the company is giving or if the company, sorry, not only the company, means any assessee is spending amount on the agriculture extension project, so 100% will be allowed to them except the land and building. For the land and building also they are not going to get any deduction. But for the for 35 cct for the skill development project, for the skill development project, this deduction is only and only allowed to a company. It is only and only allowed to a company. It is not allowed to any of the other assessees. Understood? It is only allowed to the companies, and the deduction shall be of 100%, that to accept land and building. Same thing, same thing. Any expenditure incurred by the assessee which is reimbursed or reimbursable by any other person which is directly or indirectly. Means if you are spending 10,000 rupees in the skill development project and the government or any other organization says you, if you are spending 10,000 rupees in the skill development project, we will give you 2,000 rupees back as subsidy. So whatever the amount you have spent it only, you have spent only 8,000 rupees, because 2,000 rupees has received by you as a subsidy, so it shall not be eligible for the deduction. Means what? That 2,000 rupees shall not be allowed as a deduction, means only 8,000 rupees shall be allowed as a deduction to you. Understood? Now coming to the preliminary expenses, means those expenses which are incurred before starting of the business, usually before starting of the business or can be after starting of the business. But what are the expenses covered, we have to see that. See, if or to whom we will going to give you the deduction, the Indian company or any other resident assessee, these deductions shall be allowed to you before or after commencement of the business. Whenever you have done these kind of expenses, you will get these deductions. Now what are these expenses? Preparation of feasibility report or the project report, whether this project is going to be workable or not, whether it is going to be success or not. This is what a feasibility report that we first we do the first feasibility report and then we shall move forward. Then market surveys, engineering services, drafting of MOA, AOA, legal fees, expenditure related to public issue of shares and debentures or any other expenses which is notified to them. These all expenditures are allowed to claim as per section number 35E. But understand it very carefully. For these expenses as well, na, the deduction shall not be allowed in the year of the deduction shall not be allowed 100% in the year of incurrence, but it will be allowed in five equal installment. Means if you have expended, if the eligible amount to take as deduction is 100 rupees, you can take it in the 5 years, that every year 20 rupees can be taken as deduction. Now they have said it, what is the amount of deduction? See, in that particular case they have bifurcated the companies. If you are an Indian company, there will be a different amount of deduction, and if there is a other resident SSC, there will be a different amount of deduction. But here you can see the Indian company and the other resident SSC. Means for NR it is not applicable. Section number 35D is not applicable for the NR. Can you understand this particular point? I understanding this point? Yes. Now see, for the air, for whatever the amount of deduction you will get na, for that amount you need to do 1 by 5 for that amount. So first you need to calculate the amount of deduction, then you have to take this 5 equal installment. Understood? So for the Indian company na, let me just rub it down. For Indian company, the amount which is lower of actual preliminary expenses of 5% of cost of project or capital employed, whichever is higher. First you have to take the cost of project or the capital employed, whichever is higher, do 5% of it, then compare it with the actual preliminary expenses, whichever is lower is going to be what? Your final amount. On that amount you need to do 1 by 5. Understood? And for the other resident assessee, the lower of actual preliminary expenses of 5% of the cost of project. Here the capital employed is not there. Here the capital employed is not there. Directly 5% of what? Cost of project to be taken. Now what is the cost of project? What is the cost of project? See, for the cost of project, is means any amount which is invested for the fixed asset. Either you have opened any set up any new unit, open any new project, or done any extension to it, okay, of the existing project. For that you have invested any amount for the acquisition of the fixed asset, for the fixed asset, and that too as per the books of account as on the last day of the previous year. That is going to be what your cost of project. But for the capital employed, share capital, debenture, long term borrowing shall be what the capital employed. But here it is what not written. Reserves and surplus including the share premium is not forming part of the capital asset, that is capital employed. That is for point number 3, because share capital is written, reserves and surplus is not written. Okay, to claim such deduction, if we want to claim any of the deduction, then the accounts of the previous year in which the such expenses is incurred is to be audited. If you want to claim this deduction, then the accounts which you are preparing shall be audited as well. Now if there is any pre incorporation expenses, means the company is not established as of now. If there is a pre incorporation expenses, that is allowed. But as per the ruling of the Supreme Court, it says that any pre incorporation expenses is allowed, but any pre incorporation income is not taxable. Understood? This is a Supreme Court ruling that any pre-incorporation expenses is allowed to the assessee, but any pre-incorporation income is not going to be taxable in there, hence is not taxable. Okay. Now, suppose my company ABC Limited is claiming this deduction of preliminary expenses. 3 years has lapsed. Okay. He had taken what? It has taken. Suppose 3 by 5 of the deduction. 3 by 5 of the deduction, because 3 years has lapsed. But now 2 by 5 of the deduction is left. Yes. But now this company is what amalgamated. That this company is what amalgamated to another company. Whether the amalgamated company can claim the deduction for 2 years, the balance 2 years, yes, they can claim the deduction of balance 2 years. Okay, this is also done. Now share issue expenses not allowed. Bonus issue, yes, they can be allowed. And for if there is an enhancement of authorized share capital, then it is not allowed. If there is an enhancement of the authorized share capital, then it is not allowed. Okay, clear this? Tell me, is this clear to you? Yes. Section number 35 DD, that is the amortization of expenses of amalgamation or demerger. If there is an amalgamation or demerger, and for that there is any expenses done, so for that how amortization shall be done? Same in the 5 equal installment, but this deduction shall only be allowed to a Indian company. If the Indian company has done any expenses on amalgamation or demerger, then they will get the deduction in 5 equal installment. Understood or not? Same with the VRS. If the company has incurred in any expenses for the VRS scheme, that then section number 35 DTA says that it shall also be allowed in the 5 equal installment. It shall also be allowed in the 5 equal installment. And the common point is also that for section number 35 DD and DTA, means for this amalgamation expenses or the DTA VRS, in all both the cases, what they have said that the same thing that the amalgamation has done, and the company has taken only 3 years of deduction. Whether the balance number of 2 years of deduction can be taken by the amalgamated company, yes, it can be taken. Okay, can you understood this? And the same in the case of successor. Okay, predecessor and successor, same in the case. Now section number 35E, same thing, everything is same, but here something will change. If the company is what a resident assessee, not the non-resident. Who is the assessee? Resident assessee. What he is doing? Business of prospecting or extraction of a production of minerals. Okay, from the minerals, he is doing the business from the minerals of prospecting or extracting the minerals. He will be getting the 1 by 10th of the qualifying expenditure. He will be getting a 1 by 10 of the qualifying expenditure. And what is the qualifying expenditure? We will see it. But what they have said that, see, if the profit is 2 lakh rupees of the company, but the qualified expenditure is coming, suppose 50 lakh rupees. Is coming, suppose 50 lakh rupees. So we have to do what? 1 by 10. So the deductions we can claim is what? 5 lakh rupees. Correct? The deduction we can claim is what? 5 lakh rupees. So if we claim 5 lakh rupees as deduction, so there will be a loss of 3 lakh rupees. There will be a loss of 3 lakh rupees. So this loss cannot be allowed. This loss cannot be allowed. So what they are saying that if this is going to be the case, because of claiming of the deduction under section number 35E, the loss can claim. So what they say, up to the 2 lakh rupees, which is the profit, you can claim the deduction, and the balance 3 lakh rupees can be carried forward. Understood or not? And the unallowed depreciation deduction can to be carried forward to the next previous year, but carry forward cannot go beyond the 10 years. So up to the amount you can take the deduction, you can carry forward the amount as well. Understood or not? The whole thing which is I explained is written here. Now what is the qualifying expenditure? They have said that during the year of commercial production, during the year of commercial production of 4 years immediately prior to that. Okay, now whatever the expenses that we have done 4 years prior to the commencement of your business, it is going to be allowed, and exclusively on operations relating to the prospective minerals and development of mine. And if there is any expenditure which is done even for the 4 years back, okay, 5 years back, 6 years back, but it is done for the operation exclusively for your business purposes, that is for the operation of prospective minerals or development of mine, it is also allowed. But there are 2 points where the deduction shall not be allowed to you. See, if the expenses is acquisition of site or deposits of the source of any mineral. See, if you want to extract some source of minerals, so for that you have to acquire some land. So for acquisition of land, you are not going to we are not going to give you any deduction for that. Now if there is any capital expenditure for the building, plant, machinery, furniture, for which the depreciation under section number 32 is allowed, if the depreciation is allowed, no other expenditure shall be allowed to you. Is this point clear? Now, if the assessee want to claim the deduction, then he need to prepare the accounts and also the books of account to be audited in that particular case. Now, provisions apply to amalgamated company resulting to company as if the amalgamation or demerger have not been taken place. The same thing will be applied here that we have already understood for other sections as well. Understand? Clearly, tell me this whether you have understood this or not. Shall I move forward? Now, coming to the most important section, that is section number 3580. What does it say? It says that if you are a business, we have explaining you 13 businesses approx. Yes, we have explaining you 13 business. If you are doing any of those businesses, then we will give you the certain deductions. So these are the specified businesses. But there is a thing that if the loss from this specified business came, then only it can be settled from that specified business only. So loss of a specified business can be settled from a specified business. But suppose my loss is of one specified business, can I set off from the third specified business? Yes, it can be set off. If you have two specified businesses, the loss of one specified business can be set off from the another specified business. Understood or not? Tell me that. But the loss of a specified business cannot be set off from the normal business. Understood or not? Yes. Now we are talking about what are the specified businesses. See, if we are setting up and operating any cold storage, cold chain facilities for specified products, then it is going to be what is specified business, and specified products are what related to the agriculture. Okay. Now, if you are setting up and operating a warehousing facility for storage of agriculture produce, see, here it was the cold chain facilities. Here is the warehousing facilities. Both are different. Now, laying and operating a cross-country natural gas or pipeline. Okay, it is not within the country. It should be cross-country natural gas or petroleum oil pipeline network. Then it is going to be allowed as a deduction. Now, if you are building any hotel which is of 2 star or above category, then definitely you are going to get the deduction. Now, if you are building and operating anywhere in India, here also it should be in India, a hospital with at least 100 beds, for the patient, then also you are going to get the deduction. Now if you are doing the business of redevelopment or rehabilitation of a slum area, then also you are going to get the deduction. If you are doing the production of a fertilizers, that too in India, you are going to get the deduction. Set up and operating an inland container depot or a container freight station, beekeeping or production of honey and bee wax. Okay, these are the businesses which shall be allowed as a deduction. Setting up and operating a warehousing facility for storage of sugar. Okay, see, storage of agriculture produce was written above. Now they have said that setting up and operating of a warehousing facility for the storage of sugar. Now, but see, edible oil, it is not a specified business. If you are doing a if setting up and operating of a warehousing facility for a edible oil, edible is no oil is not a agriculture produce, so it is a normal business only. Okay, now laying and operating a slurry pipeline for the transportation of what, iron ore, it is also a business which can be allowed as deduction. Now if you are in the manufacturing of a semiconductor wafer fabrication, okay, semiconductor is a very small chip which is used in every electronic device. Without it, electronic device cannot work. If you are doing any setup and operating of the semiconductor wafer fabrication manufacturing unit, it is also allowed as deduction. And if you are doing what, if you are doing manufacturing, if you are in, operating or operating, maintaining or developing what, new infrastructure facilities like road, port, airport, in that particular case as well, you will get the deduction under section number 3580. Tell me this, is this clear, sir? Whether we need to understand, we need to learn this, that commencement date? No, you do not need to learn the commencement date, and it is not practicable as for you as well. Now, what is the amount of deduction that you will get? See, the amount of deduction shall be the 100% of the capital expenditure. 100% of the capital expenditure shall be given to you in the year of its incurrence. But if the expenditure is done in before the incurrence of the business, that is before the commencement of the business, we shall give you the deduction. But in there is a condition that the amount should be capitalized in the books of accounts. The amount should be capitalized in the books of accounts. Now, the deduction under this section shall not be allowed for respect to the land, goodwill, or financial institution. Sorry, instruments. Land, goodwill, or financial instrument. These three deductions, the amount spent for these three deduction, amount spent for these three things shall not be allowed as a deduction. Understood or not? Now, point number three is very much clear to you. Something is which is not forming part of the actual cost can also not can also not be allowed as taken as deduction under any other section as well. If you are paying for 10,000 exceeding in a day other than by these modes, that is by a check or by normal check, that is a cross check or cash, it is not allowed. Okay, now if you are taking the deduction under section number 3580, then no deduction of depreciation shall be allowed, no deduction of 80 IA to 80 RRB shall be allowed, no deduction of 10 AA shall be allowed to you. Now, there is a condition that what you need to do, that if you want to claim the deduction of these conditions, then there should be a new business. All these business that is from 1 to 13, what we have said, now it should be a new business, means it should be newly formed business. There should not be a case that there is a splitting or reconstruction of the existing business. No, it should be a pure new business. And new plant and machinery should be there, but there are two exceptions to it. Means the imported old plant and machinery can be there. We will assume that imported old plant and machinery shall be the new plant and machinery. And in the second thing, the second exception is that what, if the total plant and machinery, if out of the total plant and machinery, the old plant and machinery is only the 20% of the total plant and machinery, then it is okay. Now, loss of the specified business can be set off from the specified business of profits. You know that. Okay. Now, there is a lock-in period. See, understand it very carefully. If the asset on which the 3580 is sold, then the entire sale price shall be taxable as a PGBP. When the asset always 3580 you have taken, so the cost of acquisition shall be nil. We have already taken in point number 143 one explanation that it should be taken as zero, actual cost shall be zero, and the sale price is what, suppose 100 cr, cost of acquisition is what, zero, so the whole amount shall be what, the whole amount 100 cr shall be what, taxable as PGBP. As simple as that, because the cost of acquisition is zero. Coming to the point number 8, which is an important point. What does it say? It says that there is a lock-in period. There is a lock-in period, means if you have taken any asset, okay, and on which you have taken the section number 3580 deduction, yes, you cannot sell it within 8 years from the year of its acquisition. From the year of its acquisition, you cannot sell it within 8 years from the year of its acquisition. If you have sold it, then the cost amount, I'm not saying the whole amount, I'm saying what, cost amount? No, no, no. Cost amount is in section number 33AB. What I am saying, that there is a difference between section number 33AB that we will see in the question part, and there is a section number 35AD. Okay, here both the things will be there. The lock-in period of 8 years will also be there, and will here as well. But here in section number 35AB, sorry, 33AB, only the cost amount shall become a PGVP part. But under section number 35AD, they have given a calculation. What is the calculation? What is the amount that is allowed as section number 3580 deduction? That is 100% of the amount. Okay, you have to write it down. Minus notionally allowable depreciation, because we have seen na, there is no deduction of depreciation if you are claiming the deduction under section number 30, 35 AD. So we will assume that there is no section number 3580. So we will take that notionally allowable depreciation in that particular case as assuming that there is no section number 3580 because you breached the condition. You sold it up to 8 years only. Okay, so in that particular case, what will be the amount shall be deemed as a deemed income as a PGBP. Understood? But if there is any asset which is destroyed, we have not sold it, but it is destroyed, and for that we have raised a insurance claim. So this insurance claim will be taxable as PGBP, but there is no violation of the condition. So this particular calculation you need not to do. Only whatever the amount is we are getting from the insurance claim is going to be taxable in the hands of the assessee. Understood? Now, there is an important case law of the Seabros Hotel Private Limited. What is happening in that particular case? Uh, the Seabros Hotel Private Limited has opened a three-star category hotel. Okay, if it is a three-star category hotel, so the section number 3580 deduction should be given to them. Yes, they have opened the hotel in that particular year. They have started operating that particular hotel. But suppose the approval is not received from the government department for that particular hotel. Okay, we have established the hotel, but the government department has not approved my application. They approved in the next year. Suppose they approved in the next year, so whether I will get the deduction from this year in the year of its establishment or in the year when it is approved. So the Supreme Court says that it will be allowed in the year when it is established. The delay from the government part should not be borne by the assessee. So all the expenses will be done by the assessee, will be start taking as a deduction from the year when it is established. This is what it is written in this particular case law. Understood? Now coming to section number 36. Before starting with the section number 36, I want you to take a 10-minute break. I want you to take a 10 minutes break. After that, we shall be resuming section number 36. Okay, take a break. Yes, welcome back from the break. Welcome, welcome, welcome back. I hope you enjoyed the break. Now coming forward with the other deduction, that is section number 36. See, if you have paid for the in premium of insurance of their stock in trade, if the company is paying for the insurance premium for their stock in trade, then it is allowed as deduction. You can take the deduction. Now, if a company, there is not a company, sorry, there is a federal milk cooperative society. Okay, if he is paying for the kettles owned by the members of the cattle's life, they have taken an insurance. See, there is a federal milk cooperative society and there its members. Okay, members is holding the kettles. Okay, which which gives the milk is given by the members, and members giving the milk to the FMSCS, that is a cooperative society, and by selling it they are earning what money, they are earning the profits. Understood? Yes. Now the FMCS has done what, a insurance on the cattle's life insurance of the cattle, and for that they are paying the premium. Whether they can get the deduction, yes, they can get the deduction, but if it is paid for the members only, for their members only. Understood? Now if the employer is paying for the premium of employee of the employees, premium of employees, that is of health insurance, then it is allowed, but it should not be paid in the cash, it should not be paid in the cash. Now bonus and the commission to the employees, what they are saying, that they can be given to the employees but subject to a deduction of section number 43B. Means it should be paid within the time, that is before the due date of filing of return. If it is paid, actually paid, then only the return, then only the deduction shall be allowed. See, there are payment of bonus act under payment of bonus act 1961. If the payment of bonus act says that 60,000 rupees should be given as bonus, we have paid 70,000 rupees. Whether there is any restriction to it? No, there is no restriction to it. Whatever the amount you have paid as bonus or commission, it will be allowed as deduction. Now coming to a is important case law of a Sassoon Chemicals and Drugs Limited. It is an important case law. Understand it very carefully. What does it say? Is that it says that, see, if there is a dispute between the company and the employees, okay, and the company want to give the bonus, but there is a dispute. So the court, the case is going on in the court, but the company want to take the deduction. Okay, so the deduction shall be available as per the section number 43, which the company have to pay the amount till the due date of filing of return. Yes, but what happened is, due to the court case, the company could not be able to pay the amount. So they made a trust, okay, and they deposit the amount in the trust, okay. And whenever the court case is settled, now the trust will pay the employees their bonuses, okay. The company has paid. Now it is the responsibility of the trust. They have made a trust for that. Understood or not? Yes. This is the basic nature of the fact of the cases. Now the order of the court came and the trust distributed the money clearly. Now what is to be treated as, whether the amount which is paid by the company to the trust, whether it is treated as the bonus or commission paid to the employees, and whether the deduction as per section number 43 shall be given to them. The court said yes, the deduction should be given to them, because the company has fulfilled its responsibility to pay. Okay, if the company had paid it, now it's the responsibility of the trust to pay to the employees. Now they will pay to the employees. The company has no right on that particular amount. That is why it is actually paid by the company, and we shall be allowing as a deduction. Now coming to the interest on loan part. See, interest on loan, if you have taken the loan for the personal purpose, then there will be no deduction shall be allowed for that particular purpose. But however, if you have taken the loan for the business or professional purpose, then in that particular case the deduction shall be allowed to you. But for that, the interest should be capitalized to the cost of asset up to the put to use. Can you remember section number 43(1)? Yes. Now, see, if the loan is taken from the PFI, scheduled bank, SFCs, SIICs, or NBFC, then section number 43B and applicable, and it will say that if we have paid the amount of interest up to the due date of filing of return, then only it will be allowed as deduction. Otherwise, it shall not be allowed as deduction. But if you have taken loan from any other bank, then irrespective of section number 43B, you can take the deduction. Understood or not? But if you have taken the loan to pay the income tax liability of yours, and for that loan you are given the interest, means there is the income tax liability on you. You don't have the money, you have taken the loan, and on that loan you are paying the interest. So it is not allowable as deduction because it is a personal liability. It's a personal liability, not of the business. Okay. If you have paid interest on loan advance received from sister concern, if you do not want to take the loan from the bank, okay, your sister concern can give you the loan, and for that loan you are giving the interest on that particular loan that you have taken from the sister concern, then it is allowed as deduction because it is a commercial expediency. It can be possible na, the bank is giving you the 10% of rate of interest, but your sister concern is giving you 8% of rate of interest only. In that particular case, whether it is done, yes, it can be done and it is be allowed as deduction. Understood? Now there are two case laws which is directly introduced by ICA in their question and answers. In the whole chapter, these two case laws will not be available, but in the question and answer, these two case laws are available. Directly they have introduced in that part. That is why I am taking these as well, and it is already I have already written it that this is directly introduced by ICA in the questions. Okay. Now suppose what has happened, you have issued a debentures. You have issued a debenture, so you know that on the debentures the interest is paid. Now what is done, instead of giving the interest year wise, the interest payment is done upfront in the first year itself. The whole interest payment is done in upfront in the first year itself. Whether to get the deduction in the first year itself or not, whether we can take the deduction of first year of interest paid, that is the upfront interest paid in the first year, yes, it can be taken in the first year and will not be spread out in the whole tenure of debenture. Okay. Usually it is to be paid in the whole year of debenture, but if they have paid upfront, then the upfront amount shall be taken in the first year itself. This is what the Taparia Tools Limited case law is. Second case law is what the Gujarat Guardian Limited. What does it say is that, see, if there is a loan taken by the company and the company is prepaying that particular loan, so you know that na, if the loan is taken and if you are prepaying that particular loan, so the bank charges you some premium, so that particular premium can also be allowed in the deduction in the first year itself. It can be allowed as a deduction. You cannot distribute it in the year of the whole loan taken. Understood? Yes. Now, coming to the discount on zero coupon bond. So, see, you know that the zero coupon bond is issued on a discount, and redeem at a par. So, whatever the difference is, it is only the amount that you get. Okay. So, it should be amortized in the life of the bond, but here the calculation is different. The calculation should be done in the calendar months. See, in the calendar months, if there is a 15 days or more, then it should be calculated as a 1 month. And if it is done for the if the calendar month is left for 15 days less, if it is less than 15 days, then the calendar month should be ignored. You can if you read this example, you will be able to understand it very carefully. Read this example, this you will understand it. Just the calculation of calendar month is important. If in the calendar month, if the days are 15 days or more, then it should be treated as 1 month, and if it is less than 15 days, then it should be ignored, that is 0 month. Okay. Can you solve this particular example? The solution is given, just read it. Just read it. Yes, done. This is also done. Easy question, easy example. Yes. Now moving ahead. Now see, employer's contribution, not employee. Employer contribution to a recognized provident fund and a approved superannuation fund. Recognized and approved. Okay, then it shall be allowed under section number 43. Now, if the employer is contributing to the section number 80 CCD, so the deduction shall be allowed, but it should be allowed as a lower of, subject to section number 43B. The lower of actual contribution of 14% of the salary. Salary means basic plus DA in terms of employment. Okay, so actual contribution of 14%, whichever is lower, is going to be the deduction under section deduction that should be allowed. But any contribution shall be disallowed under section number 40A9. Whatever, see, suppose the lower amount comes to rupees 2 lakh rupees, okay, but you contributed 2 lakh 14,000 rupees. So this 14,000 rupees shall be disallowed under section number 40A9. We will be repeating it. Now, employer is contributing towards the approved gratuity funds, then also it is allowed as per section number 43B. Now, expense employee. Now here, what is here? See, earlier employer, but now here it is what, employee contribution towards the welfare fund. If the employee is contributing towards the welfare fund, so the deduction shall be given to whom? Employer. The deduction shall be given to the employer only and only when the amount which is given by the employee shall be deposited to the fund up to the due date of the fund. Up to the due date of the fund. And what is the due date of the fund? It's 15th of the next month. Means here the due date of the return of income is not written, the due date of the fund is written, and the fund due date is what, 15th of the next month, and not the due date of the return of filing. If the employer deposited the employee contribution, who is depositing? Employer. Which contribution? Employee contribution. Then in that particular case the deduction shall be taken, and in that case section number 43B is not applicable. Means if you have not deposited till 15th of September, 15th of the next month, then there will be no deduction shall be allowed to you. If you have subsequently deposited it, then also you cannot take any of the deduction in the subsequent years as well. Now see, if there is an allowance of the animals used for the business or profession which are not stock in trade, if there are no if this is, if there is a business, okay, where the animals are used in the business, okay, as a business or profession, but they are not as a stock in trade, they are not used as a stock in trade, so whether we can take the deduction? Yes, we can take the deduction on, there are only two conditions. First is the death of the animal, and second is the use when the animal is not usable now, it is now permanently useless for us. Either in the case of death or when they become a permanent useless, in these two cases only the deduction shall be allowed to you, and the deduction amount shall be cost of buying minus the amount realized on sale, means the scrap value or whatever the amount you have bought, that will be the final cost of a deduction. Okay, understood. Now no depreciation on animal because plant exclude livestock. Understood. So under the definition of plant, it excludes the livestock, so there will be no depreciation on the animals thing. Okay, now coming to the important deduction, that is deduction of the actual betted. What they are saying, actual betted, we will see as well what is the provision for that betted. See, we will also see the provision for bad debt, but as of now, what we are seeing, that the actual bad debts. Okay, now provision for bad debt shall not be allowed usually, but in the case of banks, it shall be allowed. Except banks, the provision for bad debt not allowed, and how much it should be allowed, we will see in the later part. Okay, but for the actual bad debt, see, if it is related to sales, means it is related to your business, then it is allowed. But if it is not related to your business, means your business is for manufacturing something, but you have given loan to your some related parties. Okay, so in that particular case it shall not be allowed. Not only the related parties, if it is not your business now, means it is related to the loans, then it should not be allowed, except the money lending business. See, for the money lending business, the main business is what, granting the loans. So in that particular case it shall be allowed because it shall be related to the sales. So if the actual bad debt related to the loans that you have given, then in that particular case it shall not be allowed to you. Now to claim the depreciation, to claim the deduction of bad debts, two things is important. See, suppose there are debtors in the 2020, but in 2025 they are bad debts, they are not giving the amount. Okay, so what they are saying that to claim the deduction of actual bad debt, to claim the deduction of actual bad debt in 2025, in 2025 this amount should be written off in your books of accounts. First condition is that it should be written off in the books of account. Second condition is that in the 2020, in the 2020, this debtors has increased your income. This debtor has increased your income. You have offered to tax these debtors. You have offered to tax these debtors, means you have shown the debtors as a sales, and you have paid the income tax on it. Now if they become bad debt and you have written off in your books of account, then it shall be allowed as deduction. Then it shall be allowed as deduction. Understood or not? See, point number 1 and point number 2 is clear to you. Point number 1 and point number 2 is clear to you. Understood? Now coming to the point number 4. Bad debt which are recovered, then the amount shall become taxable under the head of 41(4). See, we have given you the deduction under 2025 now, but suppose in 2026 this bad debt recovered. This bad debt recovered. But we have given you the deduction now. Now we will take the tax on the bad debt recovered. Understood or not? Tell me this. And now the if the business is closed, suppose in 2026 the business is closed, then also we will treat it as then also we will take it as taxable in the head of PGBP and not IFOS. It will be allowed as the PGBP only. And now bad debt recovered taxability shall be the what is the recovery minus what are the disallowance earlier. What is the disallowance that we have not given? Suppose it was not written down, so there was no disallowance. So there was no allowance. That means everything is disallowed. So 4 lakh rupees suppose it is received to me, and disallowed was suppose 4 lakh rupees. So there will be no kind of recovery will be given to you, because we have not given you the deductions. We have not given you the deduction, so whatever the recovery is also not going to be taxable. But suppose we have given you the deduction of 3 lakh rupees, so the 1 lakh rupees is going to be taxable, which is the excess recovery. Understood or not? Tell me this basic thing. Basic thing or not? For claiming the depreciation, or sorry, from claiming the deduction of bad debt, you do not need to prove whether the bad debt whether the debt become irrecoverable or not. You do not need to prove it. Understood or not? Tell me this. Yes, understood. Yes. Moving down to the Bir Bhadra Rao Supreme Court case, which says that see, there is a successor and there is a predecessor. Okay, suppose there is Ram. Mr. Ram transferred his business to his son. Mr. Ram transferred his business to his son. Now, Mr. Ram had a debtor. But after transferring the business to the son write off the debtor because the debtor is now insolvent. Okay, but Mr. Ram had the debtor, son does not had the debtor, but son write off the debtor which is in the books. Whether the son can claim the deduction of bad debt, because the debtors was in the books when Mr. Ram was the owner. Mr. Son was not the owner when the debtors were there. Son just only write off the amount. Whether the deduction can be taken by the son? Yes. The Supreme Court says that the deduction can be taken by the son in that particular case. Okay. Now, provision for bad debt, it is also a irrelevant section. Okay. Usually they do not ask in the exam point of view because it cannot be asked. They can ask in MCQ's purpose, but for the descriptive part, they can not ask. Um, in the very least ask sections. Okay, provision for bad debts. Now understand it. In case of a banks, Indian banks, but in case of a PFI, SFC, SIIC, NBFC, these are the four things that you have already studied in the interest of loan. These are the four things that you have already studied, and there is another thing which is joined them is what? Foreign banks. Now see, in case of Indian banks, now what is the amount of provision for bad debt that should be allowed to them? Okay, see, first you need to take what? 10% of aggregate of advances by the rural branch. Whatever the advances given by the rural branch, you have to aggregate it. Okay, multiply it by 10%. Okay, this is the first amount. Second is what? 8.5% of their gross total income. Whatever is the amount is the total amount that can be allowed as a deduction to the provision for bad debts. Okay, we are not allowing the actual bad debt. What we are not allowing the provision for bad debt which is written in the books of accounts, but we are allowing this only bad debts. the balance bad debt can be disallowed and can be added back. Okay. Now the 5% of the gross total income, that is before the deduction, shall be allowed to them. Understood. Now, if you are taking the deduction under section number 3617, that is for the actual bad debt, then the provision for bad debt shall not be allowed in that particular case. Okay. Understood. Now, actual bad debt should be debited to the provision for bad debt account. This is just a provisional entry, and this is all that is need to be taken care of. Now, if there any amount which is transferred to the special reserve, then also it shall be means the deduction is allowed to a financial corporation who are providing a long term finance, not a short term finance, not short term. What they are allowing? They are allowing the long term finance, that is for 5 years or more. Then in that particular case the deduction shall be allowed. And what is the deduction? Means amount transferred to the special reserve, first point. 20% of PGP of core business. Core business is what? Their banking business. So of the PGP part, take 20%, and third part is what? From the of the share capital plus capital reserve multiplied by 200%. Whatever is the share capital plus general reserve, the amount come multiplied by 20%. Out of those two, sorry, multiplied by 200%, and out of that amount reduce the opening balance in the special reserve. Okay, this is the third amount. You will do the lower of it, you will get the answer. Okay, and if you withdraw any amount from that reserve, it is now going to be taxable under the head PGBP. Understood or not? Tell me this was. Yes, this is also a very least section, not usually asked. Now, if the employees, if the company is given their employees the family planning expenses, okay, so the deduction shall only be allowed to a company, that to in a five equal installment. For this deduction is not for every SSC, it is only for the companies. Okay, if there is a STT and the CTT paid, that is the security transaction tax or a commodity transaction tax is paid, it is allowed when it is your stock in trade. If the trading in share, securities, commodities is your stock in trade, then only it is allowed as a deduction. Okay, and if there is a mark to market loss or other expected loss, in that particular case as per ICTS it is allowed, other it is not allowed. If it is allowed as per ICTS, okay, if there is a mark to market loss because of ICTS, then it is allowed, otherwise it shall not be allowed to you. Now coming to the general section of deduction, what does it say? Section number 37 says that if you are not getting deduction under from section number 30 to 36, if you are not getting deduction under section number 30 to 36, and you are fulfilling my these three conditions, then you can come here and take the deduction. You can come here and take the deduction. What does it say? See, it says that the expenditure should not be a capital expenditure, means the expenditure should be a revenue expenditure, not for the personal purpose, means it should be for the business purpose, and it should wholly and exclusively for business purpose, means it should not be like that ki you are using it for business purpose as well and for the personal purpose as well. No, it should be used wholly and exclusively for business purpose, means 100% should be used for the business profession purpose. If these three conditions are fulfilled, then you can take the deduction under section number 37. Understood or not? Now if you have paid any expenses for the offense with if you have paid any expenses which is prohibited in the law or which is in offense of any law, then it shall not be allowed. And then it shall not be allowed, like giving a bribe, okay, hafta vasuli types, okay, this should not be allowed as a deduction, and it is included in your income. Now such expenses can be incurred in India or outside India, there is no matter in that particular thing. Now to compound any offense means, see, for any offense there is a imprisonment given in the law, but there is to avoid that imprisonment, there are certain provisions in the law that you can pay some penalty or fine in the amount that will be calculated. By paying that amount you will be released and you will not be imprisonment, you will not get the imprisonment for that particular offense. Okay, so for that, if there is any compound or offense, then also it is not allowed, or anything which will be notified by the government will be settled there. Okay, CSR expenses will not be allowed in any cases. CSR expenses will not be allowed in the section number 37. Gift to employees is allowed. Gift to employees is allowed. See, prior period expenses shall only be allowed when the liability to pay them is crystallized. Means the court says that now you have to pay these expenses, then only you have to pay these expenses, then only it should be allowed to you. Now we have given a comprehensive list. We have given a comprehensive list of these expenses. See, I have taken the case laws. Understand it very carefully. I have taken the case laws. I have taken the all ICAI questions points. I have taken the section number 37 law. Section number 37 law, case laws, I say all question points, and I have made this particular chart. What are the expenses are allowed and what are expenses which are not allowed. See, if I read these things, it will not help you at all because I cannot explain each and every point of these. You have to read it, you have to recall it, and you have to solve it. Okay, you have to recall it, read it, and solve it. This is the only way of section number 37. I am giving you 5 minutes. I am giving you just 5 minutes to read all these things. First, you will read allowed expenses till here, till here. Okay, and then you will read the disallowed expenses till here. Okay, and then we shall be moving ahead further. Okay, I am giving you 4 to 5 minutes to just read here. Then we shall be moving ahead. Okay, read it. You can read it. I am by pausing the video. You can read it. Okay, no issues. I am just scrolling up. You also have these notes. You can download it. You can take print of these notes and you can read it. Okay, I'm just scrolling up, and then we shall be moving ahead. Just we shall be moving ahead. Yes. Shall we move forward? Yes. Now, Inadmissible deductions. We shall be talking about inadmissible deduction under section number 40. Means these deductions shall not be allowed. See, in case of a NR, you have made a payment to a NR. Understood? But either you have not deducted the TDS, or you have deducted the TDS but not paid to the government. In that particular case, 100% of the amount that you have paid to the NR shall be disallowed. Shall be disallowed. You cannot claim these deduction. Okay. Now, if the payment is done to the resident and you have not deducted the TDS, or deducted but not deposited to the government, then in that particular case 30% shall be allowed, 30% shall be disallowed, sorry, 30% shall be disallowed in that particular case. Now coming to the exception to it, exception to both the sections NR and AR, that is section number 2011. What does it says? That it says that, see, the payer had to deduct the TDS, but suppose the payer did not deduct the TDS, or did not deduct the TDS. So in that particular case, what will happen? Suppose if the payee to whom the payment received, it furnishes the ROI, okay, shows that particular income in the total income, and also paid the tax on that particular amount on which the TDS liability to be deducted by the payer, but the payee itself file the return, showed the income and tax paid to him. Okay, so in that particular case, if the payer furnishes a certificate from a CA that this is the amount that is already paid by the payer, in this particular case all the details, if it is given by the payer, so there will be no disallowance attracted in the hands of the payer. Understood or not? But there will be a pen, there will be a interest shall be applicable. Suppose the TDS to be deducted, suppose the TDS to be deducted in July, okay, and suppose, sorry, no, if the TDS is to be deducted in suppose April, okay, now, but in that particular case the return is filed in July, so from April to July, the 1% per month or part of the month, the interest shall be applicable in that particular case. This is what it is written. Now coming to the royalty or fees that is charged by the central government, sorry, state government, but charging from whom? State government undertaking. The means state government undertaking paying the royalty and fees to the state government, then it is not allowed, it is not allowed as deduction to them. Now see, TDS on salary payable outside India or NR, if their TDS is payable, TDS on salary that you need to deduct, that salary is to be payable outside India to or to the NR. See, if you have not deducted it or deducted but not deposited it, so in that particular case the whole amount shall be allowed as a deduction. See, wherever the case is of NR and you have not deducted the TDS, 100% shall be allowed as 100% shall be disallowed in that particular case. Understood or not? Now, tax on monetary non-monetary purposes means, see, the company has given a rented house to the employee. Okay, so the rented house which the employee is getting, it is a perquisite in the hands of the employee, and for that he had to pay the tax on it. But the tax is also paid by the employer, that is, the tax is also paid by the employer, that is means tax actually paid by the employer on behalf of the employee, it is also disallowed for the employee. You cannot take the deduction of it. Now coming to an important section, that is section number 40b. You can see a question of section number 40b in your uh, might be in your Jan 26 attempt. Okay, see, what does it says? That remuneration or interest, we will determine what amount you can pay. See, remuneration cannot be paid to a working non-working partner. Remuneration can only and only be paid to a working partner. So they are saying that what amount shall not be allowed. So remuneration to a non-working partner shall not be allowed. So means remuneration to a working partner shall be allowed. Yes. Remuneration to a working partner is allowed. Yes. But interest to any other partner, any partner will be allowed, whether it is working or non-working. Yes, it is allowed. But they are not as per the partnership deed. But they are not as per the partnership deed. Partnership deed says that the interest will be given at the rate of 10%. You are giving only 9%, or you are giving 11%. Okay, you are giving 11%, which is not as per the partnership deed. Hence, it is not allowed. And you are giving the remuneration or interest for the period which are not covered under the partnership deed. Means the partnership deed says that from the year 2014 we shall be paying the remuneration and the interest, but you have paid the interest and the remuneration for the year 2013. This period is not covered under the Partnership deed, hence the deduction of the remuneration and interest shall not be given to it. Acha, interest deduction can only be 12% of the simple interest. Means you can pay 12% of the interest to the partner. Okay, if you are paying 14% of the interest to the partner, then only 12% shall be allowed and excess 2% shall be disallowed in the hands of the firm. Okay, in the hands of the firm. Okay, now remuneration. What remuneration can a firm pay to the partner? See, we have to calculate the book profit first. We have to calculate the book profit first. This is what the book profit is. Net profit as per the PGBP, you have to take reduce the current year depreciation and the brought forward depreciation, whatever the depreciation, current year depreciation or the brought forward depreciation, you have to reduce it and you have to add it back what remuneration if it is debited to PNL. If the PNL have already debited something remuneration, you have to add it back. You have to disallow it because we will show you now what is the amount to be allowed. So whatever you have already debited it, whatever you have already reduced it, you have to add it back, and then whatever the amount we will give you, you will reduce that particular amount. So this is how the book profit will come to you, that the net profit, out of it you can take the current year depreciation or the brought forward depreciation, and you have to edit back the remuneration if there is anything added. This will come what your book profit. After book profit, when either it should be a loss or it is a profit. So if it is a loss, then it will always come in point number one. See, in the case of loss, okay. And if this is a profit, if this is a profit, so you have to see whether the profit is, well, you have to diversify the profit. Okay, suppose the profit comes to 10 lakh rupees, you have to diversify it 6 lakh rupees and 4 lakh rupees. See, on the first 6 lakh rupees, the profit is for 10 lakh rupees. So on the first 6 lakh rupees, or in the case of loss, the remuneration can be what higher of 3 lakh rupees or 90% of the book profit, or on the balance profit, that is 4 lakh rupees, the 60% of the book profit shall be your remuneration. So this is the example. See, this is the example. This is a very easy example which says that, which is from the ICA illustration only. Okay, which says that 10 lakh rupees was the book profit. Okay, so if there is a 10 lakh of the book profit, means you have to diversify it in 6 lakh rupees and 4 lakh rupees. Of 6 lakh rupees, what it says, 3 lakh rupees or 90% of the book profit, that is 5.4 lakh rupees, whichever is higher is allowed. So 5.4 lakh rupees is allowed. Yes, for the balance 40%, 60% is allowed only, that is 2.4 lakh rupees. Yes, so if you add it back, it is 7.8 lakh rupees. Yes, it is allowed it is allowed remuneration, but you have paid what, 5 lakh, sorry, 8 lakh 50,000 rupees. So the balance 70,000 rupees you have paid excess, which is going to be disallowed, which is going to be disallowed. That is what they are saying, that is what they are saying. Understood or not? Tell me this. Explanation is of no use. You can move forward. Set of renovation no use. Come to section number 40A. Come to section number 40A. Now there are specific disallowances given. Okay, if you are paying to the relative, which is in excess of the fair market value. See, for any services which is available in the market for 40,000 rupees, and you have taken the same services from your relative and you have paid 70,000 rupees, so you have paid 30,000 in excess now, because he was the relative, you have paid 30,000 in excess. Yes, that shall be disallowed. That shall be disallowed under section number 40A2. What are the relatives? You have to see. For the individual, the spouse is the relative, brother sister is the relative, linear ascendant and linear descendant. It means the mother and father and the son and daughter. Okay, all these are the individuals relatives. And for the HUF, members are relatives, and members relative shall be also the relatives of the HUF. Means members relative are these relatives. Okay, all these shall be the relatives. For firm LLP, partner and their partners relative, company directors and their directors relative, AOP BY members and their members relative. Okay, and if the assessee is having the significant influence in any other person or their relative, then in that particular case it is also a relative. It is also a relative for that assessee. Okay, if assessee or his relative having a significant influence in any person or his relative. Okay, means I am the assessee, or suppose my brother. Okay, my brother. Okay, having a significant influence in a firm or in a company. Okay, in a company, Understood? Then it might be treated as I am also having a significant influence in the company. Okay, so this particular company will become my relative as well. Understood this skill, this thing? Yes. Now, significant influence that you have already studied, that 20% or more is the thing. Understood? If the holding company have two subsidiaries, then both the subsidiaries shall be related to each other. That you all understand and know. See now, cash payment made in excess of 10,000 rupees. If we have seen now, if there is a cash payment that is made for 10,000 or more, other than by what account pay check, demand draft, ECS means, okay, that was 10,000 rupees that you have understood. Now for 40A3, there is another point, that is there is a section, there is a point that 10,000 is applicable in general sense, but it is when it is a case of a transporter, then this 10,000 rupees limit increased to 35,000 rupees. Okay, then it shall be wholly allowed, it shall be wholly disallowed, wholly disallowed. Okay, in the relative part only the excessive part is disallowed, but for the 48.3 the whole part is disallowed, whole part is disallowed. Understood? Now coming to the exception of 48.3, that is rule number 60T, means what it says, that if you are paying for more than 10,000 rupees as well now, then also it is allowed. What are these conditions when it will be allowed? If you are paying to the government or bank or the financial institution, you can pay it, no issues. If there is only a bookish entry, if there is only a book entry that is made for the 10,000 rupees, but you have not actually paid for that, okay, 10,000 rupees not paid in a day in a single bill, okay, then also it is allowed, it is just a bookish entry. Now if you are paying to a village where the banking facilities are not available, then also it is allowed. If you are paying to your paying to the employees at their retirement benefits like gratuity also, if it does not exceed 50,000, you can pay. So up to 50,000 you can pay to your employees as a retirement benefits. Okay, now your employee is posted to a local area, okay, where the suppose where the banking facilities are not available, the bank account, his bank account is not available in that particular case. Okay, so sorry, so if he is temporarily posted for 15 days or more, then in that particular case, whether the employer can pay his salary in cash, yes, he can pay he can pay his salary in cash in that particular amount. Understood or not? Tell me this. Understood. Now, if you are paying to the money exchanger, see, if you are going to a foreign country and you want a money exchange, so you will pay the money exchanger at least 10,000 rupees and more, na? Not below the 10,000 rupees if you are going to foreign. So for that, whether you can pay to the money exchanger, yes, you can pay to the money exchanger, no issues for the foreign currency in the normal course of business. Now, for the purchase of, if you are purchasing the agriculture or the forest produce, if you are purchasing the produce of animal husbandry, if you are purchasing the fish or the fish products, okay, if you are purchasing the products of horticulture or the agriculture, if you are purchasing the products manufactured or processed without the aid of power in the cottage industry, important word is what? Without the aid of the power means in that cottage industry the power is not used, the electricity is not used, and something is produced, and if you are purchasing it, then whether you can pay it more for more than 10,000 rupees, yes, to the cultivator, grower and producer of what such articles, the product produce or the products. So whether you can pay them 10,000 rupees or more, yes, you can pay that. Now explanatory remarks is important for the exam point of view, because these are the 2 points which are usually tested in the exams. See, payment to the headman for fishermen would not be liable for deduction, okay, would not be liable for disallowance. Okay, if you are paying to any headman of fishermen, means there is a sardar, the headman, okay, the mukhia, which we can say, okay, the main person, whether you are making the payment to a headman of the fisherman, okay, so in that particular case the disallowance will not be attracted, you will be get the deductions. Okay, but if you are paying to any trader or a middleman like hawker, okay, in that particular case the disallowance will be attracted. Now understand it very carefully, read this particular point. Notwithstanding anything contained in the law, other law or any contract, whatever written in the other law or any contract, we are just overriding each and everything. Whether the payment is made by account pay check, demand draft or use of ECS, in order that such expenditure may not be disallowed as deduction under section number 48(3). Okay, so no person shall be allowed to raise in any suit a plea on ground that payment is not as per the contract or that payment is not in cash. What does it mean? See, What they are saying that if we have disallowed anything, okay, okay, if we have disallowed anything or if we have not disallowed anything, okay, you cannot, if we are in section number 48(3), okay, which we have disallowed section number which disallowed as per in excess of 10,000 rupees, you cannot file any suit or litigation based on that. We have followed the contract and we have done this. The contract says that the amount is to be paid in this at 11,000 rupees, and we have honored the contract. Whether you have honored the contract, it does not matter to me. Okay, whether any law says that you have to pay this amount rupees in a day, in a total, we does not care. If we saw that 10,000 rupees or more is given and it is not falling under rule number 60D, then we shall be disallowing it. We shall be disallowing it, or you cannot file any case against it. Okay. Provision for gratuity. What does it says that only the approved gratuity, not the unapproved, not the only the approved gratuity. What is the payment made to the approved gratuity fund? Na? Then only it is going to be allowed as deduction, not the unapproved, only the approved. But if there is an unrecognized or a non-statutory fund for which the contribution is made, then the no deduction shall be allowed to them because it is unrecognized or non-statutory funds. Understood? Now we have seen we have saw a section called section number 41, which talks about charging money, which talks about charging the tax on the incomes. Okay, they deemed as PGBP. Understood? Now, coming to the points, that is only the important thing. What they are saying that, see, if any amount is received by a successor, PGP in the hands of successor, we have already seen this. Yes. Remission by unilateral act shall be deemed to be a PGP. If there is a remission of any amount by a unilateral act, then it shall be treated as a PGP, and the assessee has written off the liability without getting the consent of the creditors. Okay. Now, if there is a time barred act which debt which shall be written off in the books of account, 41(1) shall attract. If there are a time barred debt not written off the books of account, if the debts are not written off in the books of account, then it shall not be treated as income. You have already seen this. You have already seen this same thing. Okay. If you have taken a personal loan from a friend, it is not a trading liability. Hence, 41(1) it shall not attract. Whether the loan is recovered, it shall not be treated under section number 41(1). It shall not be a PGBP income because it is a personal loan from a friend, not a business. Okay, waiver of loan by the government, always taxable because it is an income. Whenever the waiver is given by the government, then it is an income. You have rated in the points in the government. Okay, when after the 43 actual cost definition explanations, I have given you the time to read the explanation number 8 and explanation number 10 notes. In explanation number 10 note, this point was there. Yes, yes. Waiver of working capital loan, and see, these are important. Point number G and H, these are important in all these sections. Only these 2 points is important. Listen to me very carefully. Listen to me very carefully now. If there is a working capital loan, so the principal part is going to become the taxable, but the interest part is not going to become the taxable. But if there is a capital nature loan, if there is a capital nature loan na, so it is going to be non-taxable. If there is any waiver of these things, if the working capital loan is waived by the bank, so the principal part is going to be taxable, but the interest part is not taxable. But if it's a capital nature loan na, so it is all not taxable. However, such amount will reduce the cost of asset because the waiver is done na, so the cost of asset shall be reduced because you have not paid that amount. Understood? This is the basic difference. Yes. Now see, balancing charge you have already seen in the SLM method. Okay, for scientific research, if it is paid within, if it is sold within 8 years, okay. Same the recovery of bad debts we have seen it already discussed in 36 one. Okay. Now coming to the other provisions, this is the last section of your PGBP. Last section means the other provisions. Okay, we have a sections after 43B. We shall be directly jumping, we shall not be seeing this. You can just read it down one. Okay, we shall be directly jumping to the 44A. We shall only be completing the important section now because it is the other section which is a miscellaneous section, so we are not we are not focusing on that, but whatever the important section is, we shall be focusing on that. Now, expenses are allowed on the payment basis. We have most of the things we have already seen. Most of the things we have already seen. See, if following expenditure are allowed only if they are actually paid up to the due date of filing of return. We have already said that under section of when we I was talking about section number 36. I have told this for claiming the deduction under section number 43b. You have to file your return before the due date of filing of. You have to pay the amount before the due date of filing of return. Yes, I have already said that to you. Yes, already said it to you. Okay, so if there is any tax, duty, cess, or fees which is under any law in force, then in that particular case it is allowed as deduction when you will pay it. Okay, any bonus and commission already said allowed as when you pay it. See, this is the point you have already seen. Under section number 36, interest wala point. We have already seen this point. It is also allowed as deduction under I have made a curly bracket and said that it is allowed as per section number 43b. Do you know that in the case of leave salary, it is allowed as per section number 33b. See, employer's contribution everywhere I have written that subject to 43b. Yes. Now, any sum payable to Indian Railway for use of any railway asset shall be allowed as per section number 43b. See, most of the things we have already seen in the respective points. Yes, the important point is point number 7. The important point is point number 7. You must have read about the MSME Act. Okay, MSME Act, that is a micro, small and medium enterprises. The government is focusing on the MSME. So the big organization, if to protect the MSME from the big organization that they do not usually pay the amount of the MSME on time. So the big organization you should pay the amount due to the MSME on time. They have put certain conditions. What are those conditions? They have said that you have to pay the amount to the MSME which is due to them within the time limit. If you have not paid it within the time limit, then definitely we are not going to give you the deduction. See here in point number 1 to 6. In point number 1 to 6, the time limit was pay up to the due date of filing of return. But they have said that except point number 7, except point number 7, that is this. We have given here the different time limits. We will not follow the time limit of ROI. We will follow a different time limit. What is the different time limit? We have said that, see, if there is a written agreement, if there is a written agreement, so we will assume that you have to pay within 45 days. You have to pay within 45 days. Okay, if there is a written agreement. If there is not a written agreement, you have only 15 days to pay. From where? From delivery date. From delivery date you have 45 days in case of a written agreement, and if in case of a non-written agreement you have 15 days. Within this time period you have to pay the amount to the MSME. If you have paid the amount to the MSME, then only it is allowed to you as a deduction. But we are saying the MSME, but medium enterprises are not covered. Only the micro and small enterprises are covered in this particular thing. Okay, this is what it is written in point number B. Now, point number C says that what is the definition of micro and small enterprises? For micro enterprises, investment in plant and machinery or equipment is up to 1 crore rupees. It is okay. And for the turnover, if it is 5 crore rupees, then it is a micro enterprises. And for small enterprises, multiplied by 10, multiplied by 10 means up to 10 crore rupees is invested in the plant and machinery or equipment. Okay, or turnover is 50 crores, up to 50 crore rupees, then it will be treated as what? Small enterprises. Understood or not? Now, understand it very carefully, not the different notes we are going to take care. What they are saying. See, what they are saying. They are saying that if you have taken the debentures, now you have to pay the interest of those debentures, but you are unable to pay the interest of those debentures. So what you have done, you have talked to the bank or any other the debenture holder, and you have reconstructed the debentures and said that whatever the interest amount, the interest stream that need to be payable now, what we are doing that we are not able to pay. So so convert this interest payable stream as a new loan, and we shall be paying it down to you. So whether the interest payment, see that this interest payment is removed from my accounts now, and it will be treated as a new loan. So whether this interest payment is usually the interest payment, whether we shall assume that it is paid. No, it cannot be assumed it is paid, because you have made it a loan. You have not actually paid it na. That is why they will be not allowed as a deduction. Now any interest payable on loan has been converted into a loan or borrowing, then also it is also not allowed as a named deduction. Okay, because it is not actually paid to you. Now if you are furnishing a bank with a bank guarantee, It is not amounted as an actual payment, because giving a bank guarantee to the bank, it is not an actual payment. Na? Understood? Now, electricity fees is not covered under this section. If we are talking about the electricity fees, please do not come under section number 43B. And if there is an interest payable on GST, is a part of GST. If you are paying any interest on GST, then it is also a part of GST, hence covered under section number 43B. And any tax on this point number 1, you will cover it. And interest on GST has to be paid within the time limit, that is before the due date of filing of return. If it is paid, then it shall be allowed as deduction. Now coming forward and coming to the important points. Now here the presumptive taxation and the basic things is left. Okay, now coming to the compulsory maintenance of accounts by the certain person, that is 44AA. A for accounts. कैसे how you will learn it? A for accounts. See, if you do not maintain the accounts, then 25,000 rupees is the pure penalty that you have to pay. And if you are maintaining it, so you maintain it for 6 years from the end of the relevant assessment year. Your relevant assessment year ends on 31st March 2026. Now, from here, the 6 years till here means 32. Till 32, you have to maintain your accounts. Okay. Now, these are the specified profession for this. These accounts to be maintained, and other than these specified provisions, these accounts have to maintain. These are the criteria what they are saying. Let's see, if you are a specified professional, means you are a professional of legal, medical, engineering services, architecture profession, or profession of accountancy, technical consultancy, interior decoration, or authorized representative of any film artist. Are you doing all these work? Yes, I am doing all these work. So we will see whether your gross receipts is greater than 1,50,000 in all three previous preceding year. Means your previous year is what 24-25, but we are saying that previous preceding year, PPY, previous preceding year, means 23 to 24, 22 to 23, and 21 to 22. We will see these 3 years. We will see these 3 years whether your these 3 years receipt is going 1,50,000 rupees more in all, not only in one or two. In all 3 years, it should go up beyond 1,50,000 rupees, or is also likely to go in the current year if this is a case of a new business. If it is a case of a new business, so in the current year, whether it is exceeding 1,50,000 rupees, yes, it is exceeding. Yes, it is exceeding. So at least maintain the books of account, that is the cash book, general ledger, carbon copies of the bill exceeding rupees 25,000 rupees, or a daily cash register. Daily cash register. This is what a just a second. Daily cash. Daily cash register or stock register, only in the case of a medical businesses. Okay, but for other cases where these conditions is not mandatory, so at least these conditions are not fulfilled, so at least makes books of account which enable AO to compute your total income. Okay, now if you are not these professional, these are if you are not these specified professionals, so in that particular case we will see whether you are an individual or HUF. Yes, or your turnover exceeding 25 lakh rupees, or your PGP income exceeding 2.5 lakh rupees in any one of the three preceding previous year. If in any of the three preceding previous year these conditions is fulfilled, you have to maintain the books of accounts. In other person cases, we will see the turnover is exceeding 10 lakh rupees, or PGP income is exceeding 1.2 lakh rupees. Yes, in any of the three preceding year, yes, in that particular case you have to maintain the books of accounts. Okay, what is written we will see in the later parts. Okay, we will see it is the later parts. See, if you are opting for the presumptive taxation, then there is no need to maintain the books of account. We will see it later part. Now coming to the 44 AP. 44 AP is talking about, see, if you are maintaining the books of accounts now, you have to make them audit as well. You have to done the audit as well. Now what they are saying that, see, audit report, the due date of filing of return in case of the companies, or in case of the persons who have to done the audit report, the due date of filing is what 31st of December. So till 1 month prior to the due date of filing of return, means 30th of November, they have to submit what their tax audit report done by the CA. Understood or not? In case of a business, if their turnover is exceeding 1 crore rupees, in case of a business, if their turnover is exceeding 1 crore rupees, okay, so in that particular case, they have to done their audit. If they have to do their audits, but this 1 crore rupees can be 10 crore rupees if these two conditions is fulfilled. What are these two conditions? If their cash receipt out of the total receipts is only up to 5% during the previous year, and simultaneously second condition should be fulfilled, that cash payment out of the total payment is also up to 5%. That is cash, bearer check, cross check, all these things. That is only in cash. Cash includes the cash, bearer check, cross check, everything. That is other than by account pay check, demand draft, ECS, other electronic board comprises cash only. If these two conditions fulfill, then the 1 crore limit increases to 10 crore rupees. Now, in case of a profession, if the income is exceeding 50 lakh rupees, you have to do the audit. You have to do the audit. Now, if you are following these things, see, if you are following these things, understood. Now, assessee opting for presumptive taxation and claiming less than 6%, 8%, or 50%. So, the net total income and exceeding basic exemption limit means if the assessee is opting for a presumptive taxation, okay, and its net total income is exceeding the basic exemption limit, and he's showing the profit which is told in the presumptive taxation to show at minimum, and they are showing less than that as well, so they have to do their books of accounts audited, and they also have to maintain the books of accounts. Understood clearly? Understood. See, this is what it is written. But if you have not done the tax audit, you are liable to do the tax audit, but you have not done the tax audit, then the penalty shall be lower of 0.5% of the total sales of 1,50,000 rupees, whichever is lower. So minimum and minimum, so the maximum 1,50,000 rupees is going to be your amount that you have to pay. Okay, now coming to the presumptive taxation, see, for the residents only, for non-resident presumptive taxation, we shall be going into the non-resident chapter and see. For the resident chapter, the presumptive taxation we have to see first. Yes, we have to see first. See, for the presumptive taxation, for the case of a transporter, okay, section number 44 AE, section number 44 AE, what does it says that? Understand it very carefully. Understand it very carefully. Applicability we are going to see. Any person carrying on business of plying, hiring or leasing goods carriages and not owing more than 10 goods carriages at any time during the previous year means if there is a businessman who is doing the goods carriage business and having a 10 maximum 10 goods carriages during the previous year, the whole previous year, if he is having 11 goods carriages na, even for one day he is not eligible for 44 AE. He must have only 10 at maximum during the whole previous year. If for one day as well this limit increases to 11, then also it is not eligible for 44 AE. Now, what is the presumptive income? We will assume this is your income. On that you have to pay the income tax. Now, what is the presumptive taxation? We have seen that we will be bifurcating your goods carriages into two parts. The first part is what heavy goods vehicle, and second part is others. What is the heavy goods vehicle? Those vehicle whose weight is exceeding 12,000 kilograms. Whose weight is exceeding 12,000 kilograms. 1 ton is equal to 1,000 kilograms. 1 ton is equal to what? 1,000 kilograms. Okay. If there is a heavy goods vehicle, then 1,000 rupees per ton multiply by multi of the gross vehicle weight of for every month. So for heavy goods vehicle you have to do what? 1,000 rupees multiply by number of months, okay, multiplied by per ton. What is the total ton? Then it is going to be your presumptive taxation. Okay, presumptive income. For other vehicle, what they have said, 7,500 directly multiply by the number of months. You have not to multiply it by the per ton basis. Understood or not? Whatever the amount you will get, you will the this is what your presumptive income. Now, for the calculation of presumptive income in case of a firm, if it is a partnership firm, calculate the presumptive income as above. Okay, less interest and remuneration paid to the partner. You have to take the deduction of interest and remuneration paid to the partner, but this deduction shall not be allowed to other things like 44 AD and 44 AE. The deduction shall not be allowed in that particular case. Only 44 AE can take this deduction, that is of interest and remuneration to the partner can be taken as deduction. Now, if you are opting for the presumptive taxation, we shall be assuming that all the deduction of the PGBP has already been taken to you. Already you have taken all these deduction. Assessee, if if they want to declare the higher income, that we are saying that, see, we are saying that this is your presumptive taxation. If you want to show your income more than that, whether you can do so, yes. But if you want to show less than this, then you have to maintain the books of account and audit them. Okay, now income calculated even vehicle not put to use by the assessee. If it is not put to use, then also it is to be calculated. Understood? Now the assessee opting for the presumptive taxation, not required to maintain the books of account. But if they want to declare the lesser income, then he maintain the books of accounts and also get them audited. Okay, now coming to the section number 4480, that is a presumptive taxation of the business. Presumptive taxation of the business. What it says that if you are a resident individual, not the non-resident, if you are a resident individual and you have not claimed these deduction 10 AA, 80 IA, 80 RRP, if you have not claimed it, and this section is applicable to any business. We are not specifying, we are not stopping you. If it is any business whose turnover or gross receipts is up to 2 crore rupees, if he is earning up to 2 crore rupees na, then we shall be allowing it as a deduction. But for section number 44 AE, that agency, for 44 AE business, we are not allowing it because it is already taxable as 44 AE. For agency business, we shall not give you 44 AD. For the commission and brokerage business, we shall not give you the 44 AD. Okay, understood? Now, this 2 crore limit shall also increase to 3 crore rupees if your cash receipt is your if your cash receipt, the cash received out of the total receipts does not exceed the 5%. Does not exceed the 5%, then this 2 crore shall also increase to 3 crore rupees. Understood? Now, the presumptive taxation shall be what? 8%. The presumptive taxation shall be what? 8% if the amount received by us is in the account pay check, demand draft, ECS up to the due date of filing of return. But if it is, sorry, otherwise, if 8% is otherwise that it is received in cash. But if the amount is received in account paycheck, demand draft, ECS, then this amount goes to be 6% instead of 8%. Okay, this is your income. And the same thing is that only. In the same thing is that only. If you want to show higher, you can show it. If you want to show lower profits than that, then definitely you have to get your books of accounts audited and you have to maintain the books of accounts. And that is the important condition is that once you opt out from 4480, you do not want to opt out for 4480 in this particular year, then for the 5 subsequent assessment years you cannot opt 4480. You cannot opt 4480. If you want to opt it and keep opting it. But if you have opted out from 45 or 4480, then you will not be allowed to enter into 4480 for next 5 subsequent years. Understood? Now coming to a 4480 for the professional, 44AE for the transport business, 4480 for the business, and 4480A for the professionals. They have said that if the gross receipts of the professional is exceeding 50, is up to 50 lakh rupees, sorry, not exceeding, is up to 50 lakh rupees, then the gross receipts multiply by 50%. That is, a 50% is your presumptive income. But here the LLPs are not counted. Here the LLPs are not counted, and also it is also for the resident assessee. Also for the resident assessee, and same thing is written there. Now the 50 lakh rupees shall increase to 75 lakh rupees if the cash receipt does not if the cash receipt does not exceed 5% of the gross receipts. Okay, everything is basically same. And these points are also the same. These points are also the same. Like in the 4480 and ADA, the 100% advance tax can be given on the 15th of March of the previous year. They do not need to give on the quarterly basis. They can directly give the whole 100% advance tax by 15th of March. Understood clearly. Now, there are certain important deductions that I have given in the PGP question itself while solving the questions of PGP. These three deductions are very important. First is what? 80JJAA. These are only three deductions which are left, and this now the whole chapter is over. So important summary and interlinking tables are given to you just for your references. You can see it. Okay, now see, deduction in respect of employment of a new employees. Okay, if you are enrolling the new employees in your business, then we shall be giving you the deduction. We shall be giving you the deduction. It shall be available to all assessees who are doing the business and who to whom the tax audit applicable. To whom the tax audit applicable. What will be the deduction? 30% of the additional employee cost will be as a deduction. 30% of additional employee cost will be the deduction. Now, what is the additional employee cost? What is the additional employee cost? They have said that if you are an existing business, so we will see this. See, there should be an increase in number of the employees. Suppose there are 100 employees. Earlier there are 100 employees, 20 left. We enrolled the 20, we hired the 20. So the net number remains 100. So there is no additional employee in this business. So there will be no deduction shall be given to you. But if there are 100 employees, 10 left, we added 20. So there are 110 employees. So from 100 the number increases to 110. So there are 10 additional employees, and they will be, and we will be giving the deduction to them. So if there is a no increase in the total number of employees, then we will be assuming the employee cost will be nil. And if the emoluments paid otherwise than by account paycheck, demand draft or ECS, means if the cash manner it is paid, then also we shall be assuming the additional employee cost will be nil. Okay. And if it is a new business, so if it is a new business opened in this year, so every hiring is a additional employee cost. So whatever we are paying, that it shall be added, whatever we are paying, that it shall be additional employee cost, and for that 30% shall be allowed as a deduction. But there are certain conditions to that. In additional employees, we do not include if we are paying anything greater than 25,000 rupees per month, we shall not include those employees. Okay. See, if those employees is employed for less than 240 days in a previous year, we shall not count them. But if the business is of apparel, footwear, leather products, manufacturing, all these things, then the 240 days shall not be seen, only the 150 days can be seen. Okay. If it is employed for less than 150 days, then we shall not be giving them the deduction. Okay. If they are not contributing to the RPF, that is the recognized provident fund, we will not include in the additional employee cost. Okay. Now, if the entire contribution is paid by the government under the employee pension fund, then also it is not allowed as a additional employee. Okay. Now, if it is a contractual employees, not eligible for a deduction, only the regular employees will be eligible for deduction. Okay. If the contribution by employer of to the PS is not considered as emoluments, means if the employer is contributing something to the PF, it is not considered as emoluments. Okay. So it will not considered in the this 25,000 rupees, and we can be seen. Okay. Now, clearly understood clearly. And for that, you have to take what, you have to give the report of the, you have to give the report of the CA, that all these conditions have been fulfilled and books of accounts have been audited. Everything you have to give it by the CA. Okay. Understood clearly. Understood. Now, coming to 80 JGC, what it says, that deduction for contribution given by the companies to the political party. Under section number 37, you have seen, if you have read, so the contribution given to the political parties of the electoral trust are not allowed as deduction under section number 37, but can be allowed as deduction under section number 80 GGC. So while calculating the PGP, you have to add it back, but while calculating the net taxable income, that is the net total income, okay, you can take the deduction of it. So to whom it will be allowed? Only to the Indian companies to be allowed. Whatever the amount they have contributed to the political party or electoral trust will be allowed, and this cannot be done in cash. This cannot be done in cash. Whatever the expenditure incurred on advertisement in any publication, like being souvenir, brochure, or pamphlet, this can be allowed as a deduction. This can be allowed as a deduction. Now, 80M, the last section of this particular chapter, which says that what? Which says that, very easily understand it very carefully. See, if there is a company, it invested amount somewhere, yes, from where it also get dividend, yes, and this is a company which also need to distribute the dividend to its shareholder, correct? So it is what a intercorporate dividend. The company is receiving the dividend from one company and giving the dividend to its own shareholder. So it is what a intercorporate dividend. It is what a intercorporate dividend. So what is allowed as per section number 80M? See, what, whichever is lower, 80M, whichever is lower, means what does it say? Understand it very carefully from me. Whatever the amount of dividend it is received from the company, by the company, and whatever the amount paid to the paid by the company to the shareholder, whichever is lower is allowed as a deduction. But you have to pay 1 month prior to the return of income. 1 month prior to the return of income, you have to do that. Okay. Whichever is lower is going to be this. Understood? This is what your whole PGPP is. Your whole PGPP is over. Okay, your whole PGP is now over. So this is the part one where we have comprised all these things. We have consolidated the question and answer, sorry, concept. And in the part two, we will be seeing all the question and answers. Okay, take care. Bye bye. I hope you have understood all those concepts and you have recalled all those concepts. The major uh, reason of this particular batch is that you can recall everything. Okay, this is not a regular batch. I cannot go into the details. It is a revision batch where I have to explain each and everything to you in a less manner time. So I hope this batch is useful to you. Approximately in a 4.5 hours we have consolidated everything of the PGBP. So take care. We shall be doing the question answer in the next part.